firm in 2021. Each count carries a maximum sentence of 20 years in prison. The judge sent an October 28th sentencing date. And a rare miss for Apple, its Vision Pro sales won't reach 500,000 units. Market tracker IDC says its mixed reality headset has yet to sell 100,000 units in a quarter since it launched in February in the US. The international launch at the end of June should offset the weakness, and a more affordable edition, which IDC says would cost roughly half as much and should help boost sales next year. Actor and lifelong Democrat George Clooney has called for President Biden to drop his bid for re-election. He was writing in a New York Times op-ed saying that one battle he cannot win is the fight against time. It's devastating to say, but the Joe Biden I was with 3 weeks ago at the fundraiser was not the Joe Biden of 2010. He wasn't even the Joe Biden of 2020. He was the same man we all witnessed at the debate. Clooney had headlined a fundraiser last month that raised $30 million for Biden's re-election campaign. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. We'll see if we see that same man a little bit later on this afternoon. AMH will be in that room in Washington, D.C. More from Anne-Marie in just a moment. Up next on the program, pressure mounting for President Biden.
He has said firmly this week he is going to run. Do you want him to run?
I want him to do whatever he decides to do. And that's the way it is.
That's what a non-answer sounds like. More on that in just a moment. From New York, this is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Live from New York, welcome to the program. Long day ahead. Equity futures on the S&P 500 shaping up as follows. We're down about 0.1%. Yields unchanged, 427.82. Under surveillance this morning, pressure mounting for President Biden.
Does he have your support to be the head of the Democratic ticket?
As long as the president it's up to the president to decide if he is going to run. We're all encouraging him to make that decision because time is running short.
He has said firmly this week he is going to run. Do you want him to run?
I want him to do whatever he decides to do, and that's the way it is.
Okay, pause. This was the most bizarre exchange I think I've ever seen on news before. This is absolutely ridiculous. He's come out, he's made a decision. They don't like the one he's made, so the way they're going to dance around this is by saying, we're waiting for him to make a decision.
Well, okay, this is why I watched it 3 times. I'm thinking to myself, what am I missing about the answer here? There are 2 interpretations of this. One, that he's privately still deciding and they want him to actually come to a decision, and it's different than the public sort of response. And two, what a lot of people say, they all want him to step down, and they're saying, until you make the right decision, we're going to keep just being very warm and encouraging and just trying to let you come to that decision that we want.
Another one.
Yeah.
Not the one you have made already. 5:30 Eastern Time, there is a news conference. You all know that. In that room will be Anne-Marie Jourdain down in Washington, D.C. Anne-Marie joins us right now. AMH, how big is this press conference going to be, and how low is the bar for the president?
The bar is very low, but Jonathan, the stakes are incredibly high for President Joe Biden. Not only the journalists in the room that have questions for him, every single Democratic lawmaker is talking about this press conference as if this is going to be the end all and be all of whether or not he can do the job and be the nominee come November, not to mention all the foreign leaders in the room who are talking about this on the sidelines. The fact that Joe Biden's aides in November election have completely eclipsed the entire NATO conference why they're here for. So every eye, not just in Washington, D.C., but I think other capitals around the world are going to be looking at this press conference to see what the president says, to see how he acts. As you said, the bar is low for him to clear, but the stakes are incredibly high. It feels like he's on political life support at this moment.
Looking forward to your coverage throughout this morning. I know you've got a special guest lined up in the next couple of hours for us as well, so we're looking forward to that. Anne-Marie down in Washington for us, in the nation's capital, ahead of that news conference at 5:30 Eastern Time. With us around this table in New York, Ed Mills of Raymond James. Ed, good morning.
Good morning.
What did you make of that? What was your reaction to it?
To Nancy Pelosi?
Exactly.
So I think that was Nancy Pelosi, mother of five, not Nancy Pelosi, former Speaker of the House. It was more of like, oh, are you sure you really want to make the decision that you have made? And I think it was a turning point for Democrats, because what we saw is that after the debate, clearly the momentum had built to have Joe Biden step aside. Joe Biden starts to push back. He does his interview with George Stephanopoulos on ABC, and he does just well enough to stay in the race. And he starts to kind of really campaign again, and then was getting support on the Hill. And it looked as if he was securing the nomination once again. And then her comments open up the floodgate. Chuck Schumer last night supposedly arguing that he's open to the ticket. For this to change, I'm looking at Pelosi having a more specific statement. Jim Clyburn, who essentially gave the political support to Biden, and a couple of other Democrats have to be the ones that come out and tell Biden that he has to step aside, for Biden to step aside, because in his ABC interview, he said they would never come and ask him to do that. If that changes, his conversation with the media also has to change.
Before we get there, it was sort of an interesting dynamic. One of the reasons why we saw the floodgates of Democratic officials coming out and speaking out about their desire for Joe Biden to step aside was curtailed because of NATO. And it was sort of this belief, let's have NATO, let's make it sure it's okay, let's make sure that the U.S. has a strong point, and then we'll figure it out afterwards. It seems like the cat's out of the bag. We're hearing NATO leaders basically going to talk with Trump advisors to basically hedge their bets because they see that as a more likely outcome. How much is the floodgates, are they sort of shifting way beyond what you would have expected to really get this going in a sooner time frame?
So I think I was surprised by Pelosi's comments yesterday. I think NATO is an important point, to have the NATO conference in D.C., to allow Joe Biden to continue to lead the country, lead the world, is important. But the problem for Democrats is the timing is really short here. We have a ballot deadline in Ohio that's on August 7th. And so if you are going to make this change, you're going to probably have to make it before the actual physical convention and probably do it in an online convention. And so part of the question I have is how much of it is a strategy by the Biden campaign to just delay things long enough where if we get past the NATO press conference today, past the Lester Holt interview on Monday, if we have Trump nominated next week, will there be a push by Democrats to move up that virtual convention to the week after the Republican convention and shut down any question whatsoever on whether or not Biden is going to be the nominee?
There have been some inquiries into why the people around Joe Biden have kind of kept his condition quiet, why we haven't heard more about this earlier and more vocally. Do you think those are legitimate lines of inquiry?
when you are the President of the United States, that is a very legitimate line of inquiry. Generally speaking, the President of the United States has to be available at all hours, should be available to have unscripted events. It is pretty striking that we're all focused on a 5:30 p.m. press conference where it's not that many questions that you get at these press conferences and whether or not he's able to clear that bar. It is not unusual to have a sit-down interview with an anchor from a TV station as we all have to watch this moment. So we have changed our kind of general bar for what it is to be president. We have not had a press conference at the White House where Joe Biden has stood there for an hour plus taking all questions. If he could do that, why hasn't he done that is a very legitimate question for all of us to be asking.
The 3 pressure points, you've mentioned one, party officials, there are 2 more, donors and the polls. What are you hearing about where donors are, and what are you seeing in the polls right now that might change his mind?
So, John, I think if this was 20 years ago, it would be a completely different conversation about money. The folks that donate to campaigns has really broadened out. And so what we've seen from the Biden campaign is actually really good fundraising, especially since the debate. And that is a lifeline for this presidency. If it was 20 years ago, before we really saw this level of online fundraising would have already dried up, and that would have been a huge pressure point. But that flow of funds from small dollar donors is allowing Biden to stay on. And then on polls, I think we've had so many polling errors, not only here in the United States, but as recently as last weekend in France, that gives the ability for Biden to say, I don't believe those polls. And if you look at Biden's track record, every time he's been on the ballot in November, he's won, from Senate to vice president to president. He's on a winning streak that he doesn't think he's going to stop. And when you are someone who has won that frequently, you don't believe the polls. And I think he's really concerned that if he steps aside, is there time to put together the campaign to go against Trump?
He's digging in. We've got 30 seconds. Ultimately, what's the call from you? Does he step aside?
If we see a poor performance, absolutely. But I think it is only his decision to make. He has the delegates. I think as of right now, he's more likely than not to be the nominee for Democrats this November.
Ed Mills of Raymond James. Ed, it's good to see you.
Likewise.
Thank you, sir. Coming up on the program, we'll catch up with Michael Pond of Barclays. He's counting you down to the latest read on US inflation in about 2 hours from now, with some considerations as well about what this race ultimately means for inflation. I think there was a note from Michael Pond in the last couple of weeks. Can Trump make tips great again?
Yeah, basically the inflationary impulse from some of the policies that we're expecting potentially with tariffs, lack of immigration, et cetera. This is what a lot of people have been saying, and then other people say, ignore the noise.
Ignore the noise. Is it noise or is it news? Keep going back to this. Equity futures on the S&P 500, negative by 0.1% from New York. Good morning.
times in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Equity futures on the S&P 500 negative by 0.1%, just a little bit softer here in the equity market. Likewise on the Nasdaq, we're down by about 1/10. On the Russell, down by 1/10 also. Going against the grain of the last week, that's for sure. 7 days of gains on the S&P 500, the longest daily winning streak of the year so far.
And it had been sort of inching up, coughing and wheezing, as we said yesterday, to new record highs. Yesterday's was different. It had a little bit of pep in its step, 1% gain, which is the biggest in more than a month. And you saw this pretty much across the board. This is the key question. Are we starting to see the broadening out as people move away from the high flyers, but not really move away from them, just sort of, start to look at other places too?
Basically, in short, every single industry group on the S&P 500 in positive territory just yesterday. Switch up the board and get to the bond market. Lots to talk about here, particularly on the supply side. Had a guest just moments ago in the last 30 minutes, Russ Kostrick of BlackRock, who said basically even if you get softer inflation, softer employment numbers, there are limits to the rally at the long end because of the amount of supply that's coming, Lisa, over the next year and beyond.
And we've heard this. Basically, the range that we expect 10-year treasuries to trade in is something like 420 to 450. This is Russ's view. I think that there's some other people out there, including Peter Scheer, who are sympathetic to that view. Key question to me is, at what point do we see a real growth slowdown that kind of gut checks some of the concerns about the deficit? And we've heard that again and again. It's just as uncertain. So maybe this is more of a near-term call until we get maybe a little bit more visibility in the fog of 2025.
Looking for that sign of slowdown, you won't just look for the economic data, you'll look for earnings as well. In just a moment, we'll go through the Delta numbers. They dropped just moments ago. Lisa's on top of that. I just want to switch to foreign exchange just briefly. Take a quick look at what's happening with sterling. GDP was better this morning. The pound is stronger. We heard from the chief economist of the Bank of England yesterday, Mr. Pill, coming out and basically saying, throwing some cold water over the prospect of a cut anytime soon. All of this highly dependent on where inflation comes in. So sterling getting closer to 130, 128.76. If you're Rishi Sunak, you've got England in the final this weekend. The data's better. What were you doing? Calling for an election in early July, but we'll save that question for another day. As I said, Delta just dropping moments ago. Lisa, what have we got?
Basically, the forecast is lower than expected, in part because they see capacity decelerating in terms of how much it's growing into the second half. They're talking about something like $1.70 to $2 for the earnings per share for third quarter. The expectation was $2.04. They see the passenger revenue at $13.8 billion versus the estimate of $13.9 billion. Meanwhile, when you take a look under the hood, they have been beset by a huge host of costs, whether it's some of the labor discussions that they've been having, whether it's equipment maintenance, at a time when demand is still there, but the question of how much can they jack up prices really becomes relevant. I'd like to dig a little bit more into these numbers to really understand the breakdown between domestic and international travel, because that has been basically the dividing line for quite a long time.
Take your time. We'll come back to this. We'll be on top of this story throughout this morning. The number The stock is down in the pre-market by about 6% at the moment. So just pulling back on Delta Airlines in early trading. Let's get you some top stories elsewhere. Under surveillance this morning, Axios reporting Senate Majority Leader Chuck Schumer is privately signaling he's open to replacing President Joe Biden as the Democratic nominee. Schumer telling Bloomberg News, "I'm for Joe," without further comment. We're seeing this repeatedly over the last few weeks. What they tell you on the record is very different to apparently what they reportedly say behind closed doors.
The calculus is complicated because on one hand, you have people who are seeking re-election in the next couple of years, Democrats, who see it as political liability to not say something. As you've pointed out, this is actually a very odd kind of career risk on both sides. And on the flip side, you have a number of Democrats who are thinking, if we don't back Joe Biden and he doesn't leave the race, we are ensuring that Donald Trump is the president. Donald Trump, on his side, reportedly is excited about the idea of facing off with Joe Biden, as there is so much dissent in the Democratic Party, and people are talking about a landslide win by him. These are some of the calculuses underpinning some of the rumors that we're hearing as the leadership starts to test out, really pushing back on Joe Biden.
So we just settled this with a game of golf. ESPN pay-per-view, something like that. Would help out Bob Iger. He'd be happy with that too.
Can you imagine? Is the club going to have AI on it so that, a little robot can kind of do it for them?
Seriously though, how many people would pay to watch that?
It's true.
I mean, I would pay serious money to watch that.
I'm sure you would, and you know what? It's not going to happen.
Sort of watch one of them sort of hack it around 18 holes of golf. Anyway.
Who do you think's going to be worse?
Yeah, I think we know the answer to that. It's the guy who thinks he had a 6 handicap, okay? 8. All right, after the correction. Inflation's coming up a little bit later. Costco in mind. Hiking membership fees for the first time since 2017. They held off for quite a while. A basic membership is going to go to $65 from $60. A premium membership will be hiked to $130 from $120. The new prices taking effect September 1st. The stock is positive by 3%. Typically they do this, every 5 years or something like that. This one was overdue.
And that's what a lot of people who are investors in the company have been saying. Just to put this in perspective, it affects about 52 million memberships. That's the reason why we care about a $5 increase or a $10 increase in the premium membership. This is a way for them to get a lot of money. At the same time, they've been gaining share. And this has been the calculus for Costco. How much do they want to lower the bar for people to go there and sort of maybe either downscale from Whole Foods or Whole Paycheck, as Tom likes to call it, or some of the other sort of high-end grocery stores? How much are they trying to get some of the wealthier individuals who want to maybe experience less food inflation than otherwise experience?
They obviously think they're in a position of strength to do it. Let's put it that way. The stock is higher in the pre-market by something like 3%. Turning to the main event for the market this morning, US CPI data due in just under 2 hours' time. Forecasters expecting consumer prices to show the smallest back-to-back increases since last summer, boosting the case for the Fed to cut rates perhaps as soon as September. Michael Pond covers all of this, and he joins us from Barclays right here in the studio in New York. Michael, good morning to you.
Thanks for having me.
Are we underpricing inflation still?
We think so. The markets are essentially priced for Fed perfection. And as a baseline call, assuming that the Fed gets it right, at least over time, I think it's a good one. But the risks still seem like inflation is tilted to the upside.
What is it about that you see, the pillars of that call? What are the most durable pillars of that call? Where's that inflation risk coming from?
Well, as measured inflation through CPI, the most robust component is really the shelter component, as measured via rents. So there's been a lot of new supply coming into the rental market, but in single-family rental markets, there's still a lot of tightness. Again, in part because of high rates and a lack of turnover in the housing market. That means that those who would like to buy a home are left as renters. So there's very strong rental demand pushing up on rents, and so we're left with high rent inflation, despite the fact that the Fed has raised rates to try to slow it.
Yeah, this is fascinating, Michael, because we have a lot of people who come on, they say owner's equivalent rent is a flawed metric. They shouldn't be using it. Rents on any kind of empirical basis have been basically stagnating across the country. We haven't seen any inflation, and this metric of CPI would be a lot lower if they just acknowledge that. How do you respond to that if you still see housing inflation, rent inflation as being a real factor driving inflation going forward?
Well, first on OER methodology, ours is not to reason why, ours is just to understand the CPI. So it is what it is, and that's what the markets are priced off of. But when it comes to measurement, I think people are overemphasizing measures of multifamily rent inflation. whereas OER is a 50-50 blend between multifamily and single family. And so most of the indicators on the national rental market are on multifamily, and historically that's been useful in forecasting OER. But things are changing. Single-family rent inflation, as indicated by Zillow data, is almost at 5% year over year, whereas multifamily is under 3%. And so if you're just looking at the multifamily data, you're going to forecast inflation to be much lower. And I think that's why many have been missing the point on OER and getting it wrong.
How much do you see policy as a big piece of this? The idea that you've got the rent component on one side, and then you have this question around tariffs that, regardless of who wins, seem to be an increasingly relevant kind of point, as well as curtailing immigration, also probably a relevant point, regardless of who gets elected. How does that factor into longer-term inflation calls by you?
So we've been hearing from clients that they think that a Trump administration will be more inflationary than a Biden administration or a second Biden administration. It's not clear to us because Biden policies of stimulating the economy through fiscal spending have been inflationary in our view. So from a change basis, maybe they're more inflationary under Trump. We're getting tariffs either way. So it's not clear to us, but the market is saying that the consensus seems to be that a second Trump administration would be more inflationary. And given that the odds have gone up, we think the market, therefore, from a probability standpoint, should now be pricing in higher inflation over the next year. It's not, and therefore we think that shorter end break-evens are quite cheap here, just from a risk perspective.
Are you saying that you don't think the Fed should cut rates?
We think the Fed will cut rates in September. We think that data will justify that, especially when they're looking at PC inflation, which has a much lower shelter weight. So we think data will come in just soft enough on the inflation data, particularly given the Fed's shift in focus towards the labor market, which we heard clearly from Chair Powell earlier this week, that a year or so ago, it was all about inflation. And unless inflation came down, they weren't budging. Well, now with the labor market weakening a little bit, they're watching both sides of their mandate. And you could have a scenario where inflation stays relatively high, not 6-7%, but stays sticky to the upside, and yet the labor market's weakened just enough that they cut even with high inflation.
Okay, that's a really, really good point. So let's build on it just a little bit. What is it about the inflation forces that you see, and you mentioned rents, that are durable in the face of softer employment? How do those two things work?
Well, you just mentioned earlier that businesses still have pricing power, with Costco and others still raising prices. Whole paycheck. We're still seeing food price inflation, especially when it comes to restaurant workers. And so there is still that pricing power. Core goods price inflation, though, is gone for a little while. We're seeing that come in at a relatively negative rate.
You said a little while gives me the impression you think it's coming back.
Well, it could. Look at shipping rates. If you pull up a chart of the Shanghai Shipping Index, that's retraced over 60% of its pandemic drop. So again, during 2021, a lot of the core goods price inflation was because of supply chain problems through high shipping rates. Now, that's not going to impact the June print, but if that stays high and goes higher still, eventually import contracts will be reset to reflect those higher shipping costs, and that will be reflected in higher core goods price inflation.
Michael Pond, super thoughtful. It's good to see you. Thank you, sir. Michael Pond of Barclays. Great line. It's some of the research from Michael and the team, making inflation protection great again. You know, sort of paraphrasing, but just wonderful.
It's a lovely play on the reason why a lot of people think that inflation is going to be higher, although he kind of pours some cold water on that, saying, you know, the inflation is going to be present regardless of who wins.
Possibly. Let's get you an update on stories elsewhere. Lots to talk about. We've had numbers already this morning from the likes of Pepsi and Delta. With a wrap-up of all of that, with the Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Yeah, we'll get to both of those. Starting with Novo Nordisk, though, the once-weekly insulin has failed to get approval from U.S. regulators. The government asked for more information information to complete its review. Novo said the agency asked for details on the manufacturing process and the type 1 diabetes indication. The Danish pharma giant says it's evaluating the request and plans to work closely with the agency. The shares were little changed in early trading in Copenhagen, but have climbed about 40% this year, thanks to the rising potential of its obesity drug. Okay, to earnings. First, Delta, those shares falling more than 8% pre-market. It said that it expects profit this quarter to fall short of expectations, and that weaker forecast reflecting issues plaguing the broader industry. Delta and its competitors are looking to fill extra seats during the busy summer travel seasons, while rivals are pushed to lower fares to stay competitive. CEO Ed Bastian saying that price cuts have been particularly acute for June through August. Bastian estimates that the industry capacity is exceeding demand by 3 to 4%. Now to Pepsi, those shares also falling in the pre-market, down 2% for PepsiCo. It reported second quarter profit that beat expectations, yet revenue came up shy. Organic revenue in the second quarter was 1.9% growth. The estimate was for 2.9%. Demand is slipping after consistent price raises from PepsiCo, especially in North America, where revenue and volumes dropped year over year. And that's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes. Just to go back to Delta, just briefly, this was the darling of the airline sector for most of this year. Before this print, the stock was up by something like 16.5%. Lisa, this name's getting punished this morning.
It was expected to be sort of immune to some of the domestic trends because of its strong international presence. Second quarter profit fell 29% from a year earlier. They're saying this has to do with a glut of seats in the U.S. The capacity has actually gone up faster than the demand has, particularly on the domestic side. Also higher fuel costs, also something they didn't talk about. Some of the labor renegotiations have also taken a crimp out of it. What I think is interesting, over half of Delta's revenue now comes from sources such as its loyalty program and premium ticket sales.
Credit card companies.
Yes, and that, I think, is a really important point. That is bolstering them. Raises questions, what about the other airlines? And I expect them to possibly see a more damaging outlook.
It's the point you've made repeatedly, Bramo. American Airlines already having a tough year. This is spilling into the rest of the sector. American is down by about 3.7%. United down by about 3.3%. Up next on this program, allies looking for leadership.
We in Europe, we need to be carrying better our own weight when it comes to defense and deterrence. And when Trump is saying this, and it's not only Trump, we hear this also from the Democrat camp, and rightly so, then we take that seriously.
That conversation up next.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Live from New York City, welcome to the programme. Equity futures backing off from the gains of the last week or so. We're down by only 0.1%. No drama just yet. Plenty of drama in store, potentially, to add today with CPI on deck later this morning at 8:30 Eastern Time. Under surveillance this morning, allies looking for leadership.
We in Europe, we need to be carrying better our own weight when it comes to defense and deterrence. And when Trump is saying this, and it's not only Trump, we hear this also from the Democrat camp, and rightly so, then we take that seriously. And this is exactly what is happening now. We need this for our own cause, we need it for NATO, that we fortify also the European pillar of NATO. But I'm pretty certain that Europe, who invests more into its own defense, is also a better partner and a more attractive partner to the United States.
So here's the latest. NATO formally declaring Ukraine is on an irreversible path to membership once its war with Russia ends. The alliance also announcing a long-term commitment of security assistance. This as Western leaders look to shore up ties ahead of a potential Trump second term. Watching President Biden's every move at the summit, including his news conference at 5:30 p.m. later today. Down in Washington, D.C., Bloomberg's Anne-Marie. Anne-Marie, good morning.
Good morning, John. And that's right. You have European diplomats watching every single move, including some aides that told us it wasn't just Biden's speech on Tuesday, but they were concerned potentially he would drop the medal as he was putting it on outgoing NATO chief Jens Stoltenberg's neck. So this has completely overshadowed the summit. And we have someone here to talk with us about this. He's the chairman of the Munich Security Conference, also former foreign policy advisor to Chancellor Angela Merkel, Ambassador Christoph Heusgen. Thank you so much for joining Bloomberg.
Thanks for having me.
So the elephant in the room, as you know, you've been in all the meetings, you're on the sidelines of this NATO summit, is about the November election and President Biden's mental acuity. From a security standpoint, does it change the U.S. commitment to NATO, tanks on the ground, weapons to Europe and Ukraine, on who's in the White House?
Well, difficult to say. What is bothering us as we are here in Washington for the summit is that we want to concentrate on the summit. We need the NATO alliance to be strong. We want the support for Ukraine going on. And when you are on the sidelines, everybody talks about the president and there are bets being placed and all this. So I think this is
bets at NATO being placed.
No, bets on will Biden remain or not, and if he is replaced, who will be the next? So that's a lot of these talks. Instead of saying, well, how can we commit more forces to support Ukraine? The Ukrainians are battling there with Russia, and Putin looks at that and opens champagne bottles.
Because that's the state of play, and this is where what leaders are discussing, did that just undermine the entire security landscape? And are you hearing potentially for some of these officials that they would also like foreign leaders like Biden to step aside so they can focus on things like security?
No, I don't see that. From foreign leaders just want the elephant of the room to go out, and they want to know where they stand and want to concentrate on the actual work and not have it overshadowed by this non-ending debate, should the president stand or not, and what is his next move. So we hope this, as a foreigners, we hope that we'll get over this as soon as possible.
I was in Kyiv last week. Viktor Orban was there as well, and then he immediately went to go see Vladimir Putin and Xi Jinping, and now, this evening, according to Bloomberg, our colleagues, he is going to be going to Mar-a-Lago. Do you get a sense that more of these diplomats are trying to get in a room with Trump or individuals tied to Trump because they think he's going to win and they want to make sure they can fortify the NATO alliance in the eastern flank?
Well, it's not wrong to talk to the leader of the opposition, so to speak. And you may remember that then Foreign Secretary David Cameron went there. And I think he also helped to get, the former president agree to the big 61 billion package. So to talk to him, it's, is a leader of opposition, no problem. The problem is Orban. Orban is a nuisance value, and he now has the EU presidency and uses this to portray his position as EU position. So many people are mad about this guy. It's a small country, and they are benefiting from EU membership, and they are undermining European unity. So it's bad. And this from a country that was attacked by Russia, and 50 years ago, 60 years, 70 years ago. But attacked by Russia. They know how aggressive the Russians are, but somehow Orban is somebody manipulating his public and many people.
But if there's going to be a peace settlement, if there's going to be talks, Could Orban facilitate that, given the fact that he's been in the room with everyone?
He is not. He is foreign minister. He is not seen as being somebody neutral who is acceptable. As I said, he's a nuisance value. He cannot. We have to come to an agreement, but this agreement has to come from a position of strength. And you cannot come out of the position of weakness and say, please, Putin, be nice. This is not going to work. The only thing the Russians, the Soviets understood was a position of strength.
When you look at position of strength, you look at hindsight of this war, the end of 2022 was actually Ukraine's best position. Today, more Ukrainians are living under Russian occupation than they were then. Was that the moment Zelensky should have went to the peace table?
Well, you need two to tango, and Putin has always been very clear. He's clear right now. He's ready for negotiation, but on his conditions. So there is no hint that he will give up his goal. So as long as Putin believes he can win this war, as long as he believes that he has more staying power than we have, he doesn't stop. He has said that.
Do you think NATO should have come out with an actual invitation to Ukraine to join the alliance?
I think, in the long run, the only insurance the Ukrainians have and we have that we don't have, again, to invest a lot of money to support Ukraine from a next Russian attack is NATO membership. Because Russia agreed. There was a so-called Budapest Memorandum in '94. The Ukrainians gave up their nuclear weapons, and Lavrov was already there, said, no, we guarantee your national security, your integrity, your sovereignty, and they didn't do it. So you cannot trust the Russians. A piece of paper where Putin puts his signature is not valid the worth of paper it's put on. So you need solid support, and you need NATO membership.
Ambassador, when you look back at your time, when you were working with Angela Merkel, yes, was it a mistake to continue being reliant, Germany, on Russian oil and gas, and even expanding that to Nord Stream 2?
Well, this was only part of the policy. The most important is, and this is why I have this tough position. I was with the Chancellor when we negotiated Minsk, when we had the Minsk agreement where there was really a clear diplomatic way forward to solve the crisis. And Putin just destroyed everything. And of course, in hindsight, it was a bad idea to continue to rely on Russian gas. Our friends from the Baltic countries and Polish friends all advised against it. We had this long tradition, and we don't have the room to explain Germany, the gratitude for reunification. Germany was responsible for 20 million people killed on the territory of the former Soviet Union in the Second World War. So there is a lot of guilt and gratitude that position. But now we see clearly where Putin is headed, and the only way is a position of strength.
Ambassador, thank you so much for your time. John, Ambassador Christoph Heusgen, but also most importantly, he was a foreign policy advisor to Chancellor Merkel. And at the end there, he said, Germany sees clearly now. Very interesting, though. It's a distraction what's going on with the president's age here at the NATO summit.
AMH, good to catch up with you. Anne-Marie down in Washington, D.C. More from Anne-Marie in the next hour or so. Let's pull up Pfizer in the pre-market. I want to talk about this name just quickly. It is rallying. It is higher by almost 4% in early trading. And here's the headline. Pfizer advancing development, Lisa, of a once-daily weight loss pill.
How did they come up with these names? Can I just say the name is danuglipron? I mean, it doesn't, Ozempic and danuglipron. Kind of not sure exactly how you pronounce it, but basically they're planning to conduct dose optimization studies in the second half of 2024. The idea that you could potentially just pop a pill and then get skinny.
Coming to a TV commercial near you, sort of like in the next couple of years. Yeah, how's that going to work? I don't know.
How would you pronounce that?
I've got no idea. I'm not even going to try.
Maybe it's Italian. Danuglipron.
I'm not even going to try. Coming up next on the program, Sarah Hunt of Alpine Saxon Woods, Bloomberg's Josh Wingrove, Democratic Congresswoman Haley Stevens of Michigan, and Deborah Cunningham of Federated. Did you know I think the US and the New Zealand are the only markets where you can actually do commercials for prescription-only drugs?
Really?
Operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
What has been winning is the AI-fueled trade. And this is a long-term trend that's playing itself out in phases.
We don't think AI is a bubble yet. There is a growth and fundamental story here. That's why it's not a bubble.
The spread between tech earnings, Magnificent Seven earnings, and the rest of the market starts to compress as the year goes on.
Their earnings have come through. Their earnings have been revised a lot, and they have actually, give or take, delivered, if not beat expectations.
In the near term, I think investors hunker down a bit and stay in those names.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City, welcome to the program, everybody. The second hour of Bloomberg Surveillance begins right now with a bit of a shake-up in the airline sector. So let's get straight to it. In the pre-market, Delta getting punished. Delta Airlines is down by about 8.5%. Elisa, the headlines dropping about 30 minutes ago.
Basically lowering their full-year forecast, talking about second quarter profit that slightly missed, falling 29% from a year earlier. A lot of people expecting this kind of decline just simply because the comps were pretty heavy, but also because of their costs going up. But the reason for it is curious. It's because prices are getting cut at other airlines, so they have to compete to cut prices because capacity has gone up, even though when we go to the airport, it seems like all the flights are full. Just trying to put it all together. Is this domestic? Is this international? They talked about the Paris Olympics and how that's crimping transatlantic demand because people want to stay away. A lot to unpack here.
In a word, confusing, right?
Thank
and
you.
Confusing for anyone that went to the airport over the weekend here stateside. July 4th holiday weekend, record numbers going through TSA. The airport's absolutely packed. The airlines, every single plane that I went on, that other people went on, that I've spoken to, also absolutely packed, which I think just tells you why so many people are surprised this morning and why the stock is down so much in early trading.
It raises a couple of questions. Is this not the full story? And if it is, does that mean that they're going to lower capacity going forward, which will make it, A, more expensive, and B, even more crowded later on, because it's not as if travel demand is going to go down. There's also this other issue, and it goes to the heart of what we've been talking about with Boeing, with United, with the sort of turnover in staff, and that's that their heavy costs include $500 million of annual increase in just their labor spending. They also have a $350 million increase in maintenance spending. This goes to the question of the fixed costs and whether they can offset that by being a credit card company.
That's a stock to watch, and Lisa's whole point about them being a credit card company, true. I mean, for a lot of you, you agree, I know. It's not just Delta down this morning, it's also American, which is already having a difficult year. That's lower by about 4.5%. United as well, down by about 4%. We'll see if they confirm ultimately what Delta is telling us this morning. That's the stock to watch. Here's the data to watch. 8:30 Eastern time. It's 90 minutes away. It's CPI in America. Once we get through that, it's on to this one at 5:30 Eastern time. The President of the United States holding a news conference as the NATO leaders convene in Washington, D.C. And typically you might say, why do I care? You know why you care after the last couple of weeks in this country.
Basically, as we just were hearing from Ed Mills, the bar is 3 to 5 questions that he can answer coherently, and then that will basically reduce maybe some of the pressure, at least not exacerbate it in the near term for him to step down. Question that I have from a market perspective, there's going to be a lot of intrigue. We're going to be talking all about what the chances are, what the behind doors kinds of conversations are with Democratic leaders. My question is, what is the market implication for this, right? Do we have a sense of what a Kamala Harris candidacy would do for the discussion in markets? Do we have a sense of how seriously markets are now saying, okay, Donald Trump is going to sweep, but it's going to potentially be an all-Republican sweep unless Joe Biden steps out? And if that's the case, that trade becomes that much more heavily bet on. How much does this become market moving, and how much guest after guest comes on and just says, it's noise, it's noise, it's noise? Is it?
I tell you this, I know what I'm going to do every Fed decision day. 2 p.m. Eastern time, Fed decision's going to drop. I'm going to sit here and say, we're waiting for them to make a decision. Every time they don't come, I'm just going to sit here and say, we're waiting for them to make a decision. What was Nancy Pelosi, the former Speaker of the House, doing yesterday? We keep going back to this. The president seems to have made his mind up. He's staying in the race. He's not going anywhere. He's made a decision. Then we had a series of party officials come out yesterday saying, we're waiting for the president to make a decision. I mean, make sense of this mess.
Yeah, no, I'm not going to. I mean, basically, there is no way to make sense of it. If you sat in a press conference with Jay Powell after they decided not to cut rates, you said, I'm waiting for you to decide how you are going to shape your rate decision this time. It would be a little bizarre. Look, Nancy Pelosi clearly was dancing around one of two things. Either that Joe Biden is still actively considering whether or not to drop out, or the fact that she, as the former leader of the House, doesn't think he should keep running. And either of those two things are highly damaging, and both of them just raise more questions about Joe Biden's candidacy.
Anne-Marie in Washington for us this morning. We'll catch up with AMH in about 10 minutes' time. Look out for that. Here are the scores this morning. Futures are negative by 1/10% on the S&P 500. Sneak peek at a bond market action. Not much happening this morning at 428. Plenty happening a little bit later. More supply. We've had 3s, had 10s. I think we get 30s, Lisa. $22 billion worth a little bit later this afternoon.
Yesterday, the auction was very strong. The day before, very strong. Will 30s also be very strong? And is this also just simply the volatility of auctions, as we heard from Russ Kostrick? This, to me, is interesting. How much do people care about auctions when they go well? Or do they just wait until they don't to then talk about, the deficit?
I think a certain one of us might be doing the one and not the other.
I don't know, maybe it's you.
Yeah, okay, all right. Coming up, Sarah Hunt of Alpine Saxon Woods. We know who it is. With stocks on their longest winning streak this year, Congresswoman Haley Stevens amid mounting pressure for President Biden to step aside, and Deborah Cunningham of Federated ahead of key U.S. inflation data later this morning. We begin with our top story, big tech sending stocks to all-time highs, with the S&P 500 topping 5,600 for the first time ever. Sarah Hunt of Alpine Saxon Woods writing this: we still see a land grab and a spending boom on the backbone of the AI infrastructure. With valuations at high levels, there will need to be further evidence that spending does not pause. Sarah joins us now for more. Sarah, good morning. It's good to see you.
Good morning. It's great to be here.
Are you nervous about what we might hear from some of their customers later this earnings season?
I think we're still in a place, I mean, it's interesting because I saw a note that I think Goldman put out on the fact that maybe they were spending too much. And I'm thinking, how do you say that right now? It's a little bit early to say you're spending too much. It reminds me of, just to date myself, the dark fiber discussion in 2000 about we're putting in too much dark fiber. Well, the internet absorbed it all. So the question is, what is enough infrastructure? And I don't think we have the answer to that yet. It's just a law of large numbers problem now.
To build on that, should we reward the Apples, this was ultimately the Goldman call, for having some big stock buyback, or reward those that are investing all this money in the future? Some big outlays that we're seeing at the likes of Meta and other names too.
I think that's a little bit just trying to split the reality of you're rewarding the companies that have a lot of cash. What they do with that cash, as long as it's not something that seems absolutely ridiculous, is still, we have a lot of cash and that's where I want to be. So I think that, for Apple, that makes more sense for them right now. And for the other companies, it makes sense to do what they're doing. So I don't think unless it's, it's not some acquisition of something that's making no money or something along those lines.
What do you make of Russ Kosteric's argument that essentially there is a very positive story to tell with a lot of these AI companies and the sort of big tech names, but sentiment has gotten so overinflated and people are expecting such big beats that in the near term, it just seems nearly impossible for them to exceed those to the same degree. Do you agree?
I think this is the difficult part right now because there will come a point where all the spending on infrastructure will slow down or the delta will go negative or you haven't got enough use cases for the other companies that are supposed to start getting more profitable on the back of AI. And I think when that happens, and I think it may happen, then you're going to start to see people really worry about valuations. I don't think that we're there yet because I think that you're still spending a lot of money, but I think that the concern will be, okay, we've built all this infrastructure, sort of like the dark fiber argument. We have all this stuff, but we can't use it enough yet. But it will get used, and it will ultimately, I think, just not sure the use cases are what we're thinking about right now.
It feels like it's almost easier to speculate on whether AI is a bubble or not a bubble and what the potential is, rather than talk about the other 493 names and how hinged they are to an economic cycle that's really questionable. I want to go back to Delta. You mentioned Delta. It was supposed to be the darling of a cycle that benefited people who have the money to fly around the world and are doing so in record numbers. Is that sort of a signal to you that there is some fundamental problem in consumers that will percolate to a broader number of potentially consumer-facing companies?
Well, I'd love to look at the release because I didn't get a chance to go through it very carefully, but is the problem the revenue line or is the problem the cost line? You mentioned earlier the extra costs. This has been the question about what happens when inflation comes down. Do margins start to get squeezed? If this is more of an issue of margin squeeze, then it's not a problem on the economic front. It's more a problem on an individual company front because everyone's got to figure out how to deal with their costs. A lot of labor costs went up in the last couple of years. Those contracts are only starting to come through. I think that's part of it. So they might be blaming it on cutting, too much capacity, but having flown recently, I don't see any excess capacity anywhere.
Who has pricing power right now? Where do you see that? If you can pick an industry right now, who has pricing power? We mentioned Costco earlier today, putting up membership fees. Where do you see that pricing power?
I think the pricing power is coming through in the technology space. I think that NVIDIA is getting better prices than they were getting before because they're the only ones who have it. I think any place where something is in short supply, you have some pricing power. And I think on the technology side, you have more pricing power. I would argue that the airlines do have pricing power, having paid for airline tickets. But I would also say that it depends on where you're going and it depends on the timing of that. But I think that in the end, any place where there is any kind of capacity constraint, you have pricing power.
What is it about airlines that everyone just loves to rant about? I mean, I could join you too. It costs a fortune and it's miserable. Why is it always miserable?
Because we are at a point where so many people are flying that even as they're increasing capacity, the airlines, the airports can't handle it. The airlines can't handle it. There's nowhere to sit. It's hot. I mean, I can go on and on.
I remember when I was a kid, I used to go to the Midwest frequently because my family lived there. We flew on Midwest Express, which they had, glass little salt and pepper shakers and home baked. It was a very nice experience. Everything was first class and it went out of business. But you raised this question about how much you end up with cost structures that are only now getting bigger. Do you think that people are underestimating the margin compression that we could potentially see this cycle? Because, yeah, the pricing power is in NVIDIA, but it's not necessarily in Delta? I mean, it kind of is, but we thought it was. But it isn't necessarily in some of these other areas that are also dealing with fundamentally higher costs that haven't come down.
I think we were concerned that there was going to be margin compression earlier than there has been. So it might just be that there's a lag on that margin compression because the costs haven't really caught up yet. Everything, we're such immediate people. The price changes today. We can see this today. in business cycles, things take longer. Contracts take longer to play out. It takes longer for people to figure out exactly what their cost structure is going to look like. Fuel prices have come down. That should have been of help to them. But it also might be that because they were using fuel that they'd bought at higher prices, it won't come down until the third quarter. So I think that there's a lot of rolling cost situations that we can't see because we're not those corporations. And we're looking at things from that, Wall Street immediacy level of I need to know today what's happening tomorrow. And I think that that's something that is going to have to play out in the next several months. And we're starting to see whether or not that's going to happen. I don't know if Delta's a bellwether or if that's just a one-off for them.
What are you more interested in today, CPI or the president's press conference at 5:30?
Yes. I think that both of them are important, right? I think that, you had a guest on earlier today who said that one number isn't the most important thing. Well, it's not the most important thing unless it goes very much in the wrong direction, right? So if CPI went very much in the wrong direction, it would be the most important thing. I think that there has been chaos since the original debate, and I don't think that that chaos is yet over. I think all of the discussions you were having earlier, none of what anybody is saying makes sense except tell me something I want to hear. And until I hear what I want to hear, I'm not believing what you're saying. And so that's where we seem to be. I don't know that that's going to make the press conference today is going to make that any different. I don't think to the extent, it's unfortunate, but I don't think to the extent that, it's not wrong that age is not something you can take away.
Noise or news? Do you think it's real news for this market, the considerations that are percolating over the last few weeks?
To the extent that we've seen both of these people as president and the market has reacted well to both, I think I understand why people say whoever's president is noise. But political chaos is not just noise. And if it gets too chaotic, I think that that is going to take people's risk appetite down to some degree. But we don't know that yet, and we don't know what kind of decisions people are facing right now. We know where one side of the ledger is. We don't yet know where the other side of the ledger is, even though he keeps saying he is that side of the ledger, and nobody seems to believe him.
We're waiting for him to make a decision, Sarah. You know that. Sarah Hunt of Empire Saxon Woods. Sarah, it's good to see you. Just wonderful. Thanks for catching up with us. Let's give you an update on stories elsewhere. There's plenty of stuff going on through this morning and throughout today. With your update, your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Starting with oil, global oil demand growth slowed last quarter to its weakest in more than a year as China's post-pandemic recovery fades. That, according to the International Energy Agency. Demand is on track to grow by less than 1 million barrels a day for this year and next. That slowing fuel use will be comfortably met by a flood of new supply from the Americas, according to the agency. Apple aims to ship at least 90 million iPhone 16 devices in the second half of this year. The tech giant is counting on AI services to fuel demand after a bumpy 2023. The company reportedly told suppliers and partners that it's targeting around 10% growth in shipments of new iPhones compared with the predecessors. And Manhattan's apartment market reached new levels of competitiveness in June. A record high 24% of leases were signed after bidding wars last month. That, according to brokerage Douglas Elliman Real Estate and appraiser Miller Samuel. Units were listed for an average of just 24 days before getting scooped up, an all-time low. And renters paid a record high premium of 1.4% above listing prices on average. Rents, though, were still fairly steady for the month. The median new Manhattan lease was $4,300, unchanged from a year earlier, and $50 more than the month prior. And that's your brief, John.
Danny, thank you. Don't let them get to you. The most important number in all of that was $4,300. The median rent is unchanged over the last 12 months. Of course, the brokerage wants us to think that there's massive bidding wars going on in New York City, so we can all start these stupid bidding wars between ourselves.
How do you feel about this, really? I mean,
you know,
yeah, well, I hear about all these people who don't really kind of move into the city.
There's a bidding war, but rents are unchanged from a year ago. But there's a bidding war. I hate it.
Are you in a bidding war?
No, I'm not in a bidding war, and I won't be either, all right? Up next on the program, pressure mounting for President Biden to step aside.
Should he, as some people have suggested, just go ahead and take a cognitive test and demand that Donald Trump do the same?
I don't think that'd hurt, to be honest. But at the end of the day,
So you think that he should take a cognitive test?
I don't think it would hurt.
That conversation up next on the program, live from New York City this morning. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
You see, you remember this?
Yeah.
They did this with Beanie Babies. They made people think they were like bidding wars and you had to sort of rush and take them off the shelf.
Beanie
That's what they're
Babies.
doing with rents in Manhattan.
Cabbage Patch Kids.
Yeah.
Manhattan Apartments.
Quickly, go get one.
Yeah, exactly.
I've got one already, but I need another one.
My kid's coming to me, please, I want an apartment.
Yeah, in pink, the unicorn version. You know, like, do you remember this with Beanie Babies?
Yes,
That's absolutely ridiculous.
Yes, I remember that,
All right,
but, you know,
less of
Beanie
that.
Baby is a
Okay,
little
I
bit
get it.
different
Let's get back to the markets.
Manhattan Apartment.
Equity futures on the S&P. Can't do that with apartments. All right. We're down 0.1% on the S&P 500. Ask the guy that bought that apartment the other day. 120 million.
Okay, I don't think that this is quite the same kind of
bidding
issue.
war.
Okay, come on. We're talking about two completely different things.
428 on a 10-year this morning. Under surveillance. Pressure mounting for President Biden to step aside.
President Biden and Vice President Harris are showing up with real receipts, making people's lives better.
What more should he do to shut this conversation down? Should he, as some people have suggested, just go ahead and take a cognitive test and demand that Donald Trump do the same?
I don't think that'd hurt, to be honest. But at the end of the day, you know,
So you think that he should take a cognitive test?
I don't think it would hurt.
Here's the latest. Fractures deepening in the Democratic Party as a growing number of lawmakers question Biden's fitness for a second term. Vermont Senator Peter Welch becoming the first Senate Democrat to call for a new candidate on the ticket. The president set to deliver a crucial news conference later this evening at 5:30 Eastern Time. Let's head to D.C. and catch up with AMH alongside Bloomberg's Josh Wingrove. Anne-Marie, good morning.
Good morning, John. That's right. And Josh and I will both be in that news conference this evening. Josh, I want to get a sense from you. You're talking to the White House. You've seen how it's been with the NATO summit. Basically, the elephant in the room is Joe Biden's age and whether or not he can lead the free world. Does the White House feel the same way, that everyone is just billing this press conference? High stakes, kind of a do or die moment.
It depends on who you ask. Some do, some don't. A lot of people close to Biden are saying, hey, that letter we sent on Monday to lawmakers saying basically, shut up, get in line, I'm running, that stands. That is his position. We were told by sources yesterday, as recently as last night, that Biden hasn't wavered a bit in that decision to run. He's not convinced. Pelosi's sort of surprise event yesterday, whatever we're calling it, however we're interpreting it, has not wooed him. But there are nerves across the Democratic Party, not only in the lawmakers who are speaking out publicly, but among others who are allies of the president, that this has gained steam. I think 24 hours ago, if we were sitting here before Pelosi had spoken, Biden allies felt pretty good. And they kind of thought, you know, things had gotten back in the bag a little bit. Jerry Nadler, for instance, on Sunday said that Biden should probably not be the nominee, and on Tuesday had come on and said, he's sticking around. There's nothing really we can do. We're all for Team Biden. And now it feels like the wheels are coming off a little bit again. So all eyes are on this press conference. If it goes badly, then I think we'll see more momentum towards the question of whether he should be the nominee. If it goes well, maybe they can, put the cat in the bag again.
There's also the donor class. And the Financial Times this morning has some quotes from New York donors. One saying they can't believe they're saying this, but they wish there would be a gaffe tonight because something so big that he fails that he just steps aside. I want to ask you, because we heard from one important donor from Hollywood yesterday as well, who does the White House view as Brutus at this moment? Is it the Nancy Pelosi remark yesterday, putting it back in Biden's corner, where you made a decision, but maybe think about it again? Or was it that George Clooney opinion piece?
I think it's more Clooney. And Clooney came with more than just his opinion, right? A lot of Biden allies said, celebrities, we don't listen to celebrities. We listen to real voters. But Clooney was at an event. Anne-Marie, you and I were at the G7. Biden was there. He left early, skipped that Ukraine peace summit in Switzerland to go to this fundraiser with George Clooney. And the video from that fundraiser was one of the ones that has really stoked age concerns in and around the debate. He looked a little out of it and kind of had to be, steered off stage, handled, however you want to say it. And so Clooney came out yesterday not only saying Biden should not be the nominee, but saying that the guy he saw at that fundraiser was the same one at the debate. In other words, it isn't just the debate, it's other things as well.
That goes back to a Nancy Pelosi point of, is this an episode or condition? And George Clooney's opinion piece almost said, this is not just a bad night, this is a condition.
Or at least there's been more than one episode, yes. And of course, one of the justifications for the president's self-described bad night at the debate was he was tired, he was traveling that month twice to Europe, and that is true. I will note, all eyes on tonight. It's not been a light week for him. He's hosting a NATO summit, one that's been pretty successful as NATO summits go. I'm sure he wants to talk about that. I think tonight we'll see him try to put the contrast more on Trump. I wouldn't be surprised if the phrase Google Project 2025 comes out of his mouth. They really want to steer the conversation more to that, if only as a message to their own party that this is a contrast election and that is Biden's best path.
You're in and out of the White House every day. Just quickly, I want to get a sense from you on how palatable it is, this concern. A source once said to me that worked for Bush, said anything you see in the press, it is always 20 times worse inside if it's that bad in the press.
Yeah. Some are putting on a happy face, but the mood yesterday was rough. I mean, people are not jazzed at the moment, and for a range of reasons. Some of them think the media are disproportionately going after them. Some of them are mad that Democrats are speaking out, perhaps understandably. And some of them just have this deep sense of dread about all of this, and that one way or another, this is wounding the Democratic brand heading into the election. It's rough right now, and I think that for some of them who might have felt comfort 24, 48, 72 hours ago that, everyone is sort of falling in line behind the president, right now, it's, I think, more of an open question. Peter Welch is not a firebrand who pops off, to have a senator like that come out and say that is, I think, indicative of wide concern, as opposed to like Senator Romney saying something about Donald Trump when every other senator, the Republican senator, didn't agree.
And just quickly, if he has this press conference tonight, why schedule and promote on a Wednesday the NBC interview Monday evening?
You're the media expert, you tell me, Anne-Marie. I don't know. There'll be a lot of eyes on that. Remember, that also is in a trip to Texas and Nevada. He's also going on Friday to Michigan. This is important. He went to the AFL-CIO yesterday. Biden is campaigning right now. He's got his, pedal to the floor on it, which is a signal that he doesn't intend to step aside. And so for Democrats who are coming out, they're trying to essentially pop that bubble and have him at least recognize that they have deep concern. But right now, he is flooring it. Michigan, he's speaking with black voters. He's touting support from the Congressional Hispanic Caucus. He's really going to all these key constituencies in the Democratic Party that have been supporters not only of the party, but of Biden specifically as a lifeline to basically save his hide here.
Josh Wingrove, White House reporter, thank you so much for joining me today. John, and Josh and I will be in the High Stakes News Conference this evening, and you talk about Biden hitting the floor campaigning. ABC, Washington Post have a new poll today. More than 56% of Democrats think he should step aside.
Looking forward to the coverage later, guys. Thank you. AMH with Bloomberg's Josh Wingrove. I think we could all make a basic observation as to why you would announce an interview that takes place on Monday and announce it on a Wednesday. You want to stretch this out. You know that if you burn through enough time, ultimately time runs out for people to get you to stand aside.
Which has been basically the strategy. If they just keep gunning it, then essentially people will have to get in line. Also, basically saying, I'm still going to be there Monday, so stop trying to wait for me to, drop out on Friday after the press conference.
And you know how low the bar is this evening? It's super, super low.
Yeah, it is. Although even that's not going to quell concerns. That's the real issue.
Talk about more of those concerns up next on the program. Don't miss this. Anne-Marie sitting down with Democratic Congresswoman Haley Stevens of Michigan. That conversation up next from New York. This is Bloomberg.
of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Stocks on quite a winning streak, closing yesterday at all-time highs, coming into Thursday at a record with equity futures negative 0.1%. This is a really mild pullback on the S&P. On the Nasdaq, we're down by about a tenth. The stock of the morning is Delta. We'll get to that name in just a moment. That name is down and down hard in the pre-market. Switch on the board and get to the bond market. More bond supply coming later. 30-year bonds coming to market with the 30-year yield at 4.47. Yields pulling back just a touch by a basis point. Just about, not even half a basis point on a 10-year right now, 4.28. CPI coming out a little bit later this morning. Want to finish on foreign exchange. The euro stronger for a second session. The strongest it has been since early June, so in about 6 weeks or so. Euro right now, 108.51, positive by 0.2%. Under surveillance this morning, here's that name for you, Delta, delivering a disappointing outlook, expecting profit to fall short of expectations as heavy competition in the domestic market is driving ticket prices down. That stock is being driven down by that announcement. We're down in the pre-market, Lisa, by 9%.
This is what we're talking about. Adjusted earnings about $1.70 to $2 a share in the third quarter. The expectation was for $2.04. So not a massive miss when you take a look at things, all things considered. That said, we're talking about a huge 29% decline in second quarter profit from a year earlier. A lot of questions here. How much is it because of how much the cost base has increased? How much is this because of fuel prices that have gone up, which they don't have a lot of control over, and none of these airlines really hedge anymore? How much does this really have to do with the ticket prices actually having to be competitive on the domestic front? And they throw in that the Paris Olympics are reducing transatlantic travel because people don't want to go to Paris unless they absolutely have to avoid the crowds. Again, there is a mystery underpinning this, and you can see that mystery percolating out in the other shares.
And of everything you just said, the one thing that made the most sense was going to Paris around the Olympics. It would be absolute hell. I mean, I wouldn't get that flight either. That makes perfect sense.
But it makes me think that maybe, actually, it'll be less crowded because fewer people will be going, and everybody who does go will be in the stadium. So, I don't know.
Let me know how that goes for you.
Okay,
it's going to be
sure.
hell. We all know it's going to be hell.
Okay.
I think this is perfect timing. We've got CPI a little bit later this morning. It's about an hour away.
Yeah.
And what you're hearing there from the airline sector is just maybe some price sensitivity starting to come to the surface, some discounting. Now, I know for a lot of people that might have bought flights, airline tickets over the last few months, you may be not feeling that, but that's what's coming through in the numbers and the commentary.
So Neil Dutta sent out the story about Delta and then said he put the headline, right, and he put the first line of the story that it expects profit to fall because heavy competition in domestic market, and he underlined this, bolded this, and made this extra, extra large, drives ticket prices down. Basically, this is the disinflation that people are talking about, the consumer pushback, and you could see it even in one of the hottest sectors, the travel.
Chair Powell acknowledging some of this at least, believing inflation is heading lower, but he's not ready to basically declare mission complete. The job isn't done. The question is, and this is a quote from Chairman Powell directly, are we sufficiently confident that it is moving sustainably down to 2%? I'm not prepared to say that just yet.
So he didn't want to open the door completely to September. This is essentially him not wanting to tip his hand. To me, I thought it was fascinating, this sort of personal moment when they asked, what keeps you up at night? And he said, finding that perfect balance between not seeing a spike in job cuts and achieving that 2% target is the number one thing that keeps me up at night, trying to make decisions that give the best chance to happen. That is the thing I think about in the wee hours. This is a Fed chair who desperately wants to nail a soft landing at a time where he is flying blind. We don't have a sense of how quickly any kind of deterioration is happening, and we don't have a sense of visibility into the inflation picture.
Speaking of deterioration on the president, and a serious note, and linking it to Chairman Powell, did you see what Powell said yesterday? Hasn't had a meeting with Biden in 2 years. Said this, I haven't had a meeting with him, he hasn't sought a meeting, and of course, I don't seek meetings. There's a kind interpretation here and a less kind interpretation. The kind interpretation is the president is really focused on making sure that the central bank retains its independence and doesn't have those meetings. The less kind is that conspiracy, can we even call it one anymore, that the people around the president have been maybe insulating him from having meetings with people outside of the White House?
You know, I listened to that clip actually repeatedly. I really had a great, exciting night last night. But I was listening to his answer, and he was trying to spin this as sort of a vote of confidence in Fed independence, saying that essentially this is a good thing. We shouldn't be meeting with the president. And the senator was saying to him, the representative was saying to him, actually, inflation is incredibly high. This is one of the main points. Isn't it surprising to you that he wouldn't meet with you? And the Fed chair was saying, no, we just do our thing. It does just add to the questioning. I'm not going to make a conclusive kind of statement about this because I don't know. But it just ongoing adds to the drip, drip, drip that we've been hearing all around.
Yeah, Chairman Powell doesn't want to touch this subject. It's had 2 days of people trying and did not want to touch this. So President Biden, as you all know, is facing mounting pressure from his party to drop out of the race. The latest voice, Vermont Democrat Peter Welch, becoming the first sitting senator to directly endorse replacing him on the ticket. Anne-Marie is in Washington with a special guest, the Democratic Congresswoman Haley Stevens of Michigan. AMH is over to you.
Thank you so much, John. And Congresswoman Stevens, you're also going to be in Michigan tomorrow with Biden.
Yes, I am.
You're a staunch supporter of him, and you're not backing down. Why?
I'm really enthusiastic about this campaign and what we've built in Michigan. I've been rigorously on it since the beginning of the year. Detroit is at its lowest levels of unemployment in 50 years. We have manufacturing growth. I have a really popular governor, Gretchen Whitmer, who's endorsed this president, who's a co-chair of his campaign, who's met with him since some of the debate fallout and is sticking by him in the commitment to stand up for women's reproductive rights, to tackle our gun violence epidemic that has hit us pretty hard in Michigan. And there's a team, right? We have built an incredible ground operation, and it's hard work with persuasion voters, with turnout. I don't want to turn away from this, though, now. I want to keep going. 15 some weeks left. Let's bring this over the finish line. And I believe and know that the Biden-Harris ticket is the one to get this done for us.
Do you think he's the best candidate, though?
I do.
You see the polling today from Washington Post, ABC. More than 56 Democrats say, 6 in 10 independents say he should step aside. Is it that he's the best candidate at this moment, or there's concern about basically telling a sitting president, the leader of the party, that it's time to go?
Look, the stakes are high. The other thing that the polling is showing you is that people are freaked out about Donald Trump coming back. What that means for young women, what that means for our economy that spiraled out of control when he was president during a global pandemic that was not well handled by him.
But polling also shows people think Trump would be better when it comes to things like the economy, which our polling shows is still the #1 issue.
It is the #1 issue. And it's not just look at the facts today. Look, polling is absolutely important. I have to look at polling, and I have had polls that have led me down a path of success, and I've had polls that have led me wrong before. But What I know is that people are concerned about Trump. I mean, I hear that on the ground in Oakland County, Michigan. It is palpable. People want to win. These stakes are high. Obviously, when President Biden was gathering his delegate votes and campaigning in the small primary that he had earlier this year, it wasn't 100% clear every step of the way that Trump was going to be the nominee. Now he's hiding in Mar-a-Lago. We don't see him really very much. He's come to Michigan maybe once or twice, a few surrogates here and there. Pretty quiet from him. And in part, we've got a president who's governing, who's leading NATO, who's got the backing of international leaders who support his plan. We have, by the way, a major foreign aid package that got done in a divided government. That's exactly what Joe Biden asked for.
But I think the concern is not so much can he lead right now, it's what does the next 4 years mean? And you mentioned Governor Whitmer. She was on CNN last night and she was asked, should he take a cognitive test? Her answer was it wouldn't hurt. Do you agree with the governor?
Yeah, well, Trump joked around about his own cognitive tests and, that he was some super genius and was spouting off things. Look, anything the president needs to do to reassure people. I have been recently with him when he announced tariffs on Chinese EVs and critical minerals. I was in the Oval Office with him for an extended period of time. I haven't seen one decision coming out of this administration under his leadership that concerns me. I also know that we have got a message for the next 4 years. It's clear people are spooked. It's also clear, though, people are united to do whatever it takes to beat Donald Trump, and we've got the campaign to do it. We really do.
You've spent time with him recently. You're going to be with him tomorrow.
Yeah.
You said there's not a decision that makes you rethink this that's coming from President Biden, not a decision you see that concerns you. But what about his speech, the way he walks? Actual deterioration in his health. Have you seen any of that?
Not really, to be honest with you. I mean, look, I know I can't tell people to unsee what they saw in the debate. I thought he answered it honestly. Look, it's not news that he is the age that he is. I look at this and I see flawless execution from this administration. COVID relief, infrastructure dollars, not just bills that have gotten passed, but things that are being executed flawlessly, like the CHIPS Act, which is so important to our Michigan manufacturing economy, something that President Biden has championed. His campaign message is let's finish the job. There is more to do. It's promises made, promises kept. There are more things that we need to accomplish here that are on the horizon. Paid leave, funding for our public schools, support for our educators, the next generation. This is a real campaign. And look, this is a tough moment. It's been quiet. We've had 24/7 Trump TV and his convictions and all that insanity. I don't want to go back to that. My voters in Michigan are terrified of going back to that. I mean, the former president pretends that he supports unions, goes to a non-union shop. We worked for the UAW. We got the UAW endorsement. We've had this whole process here. We're weeks out from our own convention. We got to stand up to this Trump team.
Union leaders are concerned. Washington Post this morning, there was a behind-the-scenes meeting yesterday. Sean Fain. President Biden went and stood on a picket line with this man. He is now voicing his concerns. So when you're in Michigan and you hear from union leaders, Trump is chipping away at these people. Michigan, potentially, Biden can lose. That's what Congresswoman Slotkin even said on a recent donor call.
Yeah, look, we want the winning campaign. And our union leaders, they're deploying their members to knock doors, to evangelize this effort. And that's what you do in closed-door meetings. You do say, hey, what's our plan? How we're going to do this? We're the Democratic Party. Differing opinions, expression of opinions. I've had 4 to 5 Republican members of Congress from Michigan who've either left their party, impeached the former president, or got voted out. I mean, give me a break. Like, this is how it works in our party. It's a good and healthy thing. And I'm going to tell you something else that I know about Joe Biden. He is the ultimate comeback king. He's the most underestimated individual in American politics. He always has been. He's got a good North Star. He's tapped into his faith. He's been through things that have tested him for this moment. And yes, he's our older, wiser president. He has not steered us wrong, and he has got a vision alongside this amazing team that he has to continue to win the future for us.
Congresswoman Haley Stevens, thank you so much for your time. John, of course, that was the Congresswoman from the 11th District in Michigan, key for the president if he wants to win that state, and she'll be with him campaigning tomorrow.
MH, thank you. Looking forward to more from Anne-Marie Drab this morning. Anne-Marie there with Congresswoman Haley Stevens. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's get to Danny Berger. Hey, Danny.
Hey, John. Costco is hiking membership fees for the first time since 2017. A basic membership goes up to $65. It was $60. A premium membership goes to $130 from $120. Those new prices take effect September 1st. Executives had said that the increase was only a matter of time thanks to strong renewal rates, new signups, and customer loyalty. Costco does usually raise fees about every 5 years. Pfizer shares this morning are higher in the pre-market, just under 2%. The pharma company announced it's making progress on its once-daily weight loss pill. The drug has cleared its first hurdle in a scientific study. Now it progresses to a mid-stage study in the second half of the year. It is a promising sign for the drug maker, who's been trying to break into the multi-billion-dollar market for obesity medications. And it was an incredible end to England's match versus the Netherlands in yesterday's Euros. Aston Villa's Ollie Watkins scored the winning goal in the 90th minute after being subbed in and only touching the ball 4 times, along with an equalizer penalty from Harry Kane in the first half. England won 2-1 and will go on to face Spain in the final in Berlin. That match Sunday at 3 p.m. Eastern. And that's your brief, John.
Danny, thank you. I'd love to see the back pages of the Dutch newspapers this morning, the sports pages. Can you imagine if this was on, the shoe was on the other foot, so to speak?
Yeah, well.
And the Netherlands got that penalty that England received.
What do you think
yesterday.
happened there?
I'm going to save my own thoughts on that matter for another day. I'm going to do like, what a lot of politicians do in Washington.
Yeah.
What I say on the record,
Yeah.
different to what I say behind closed doors.
You could just say to the ref, I want to wait until you make a decision about that call that you made.
I think the referee did a great job. Up next, Powell remaining patient.
We want to be more confident that inflation is moving on a path sustainably down to 2%. Not at 2%, but on a path sustainably to 2%. That's the test we've articulated.
That conversation up next. CPI, 46 minutes away.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Just got a great note. The latest consumer checkpoint from Bank of America and the Bank of America Institute. This line here, it's amazing. We find a 23% year-over-year increase in households with in-person spending in cities across Europe where Taylor Swift has been performing. You know, in a morning where we're talking about Delta
Right.
maybe struggling, and you're talking about international travel and going to Paris, a 23% year-over-year increase in households with in-person spending in cities across Europe where Swift has been performing.
Well, how many times have we heard about this? That basically it is cheaper to get tickets on a plane, in a hotel, and to Taylor Swift over in Germany, over in France, anywhere but the United States, and that is what a lot of people are doing who have daughters of a certain age.
Yeah, the latest from Bank of America this morning. If you are just joining us, welcome to the program. CPI, the next big stop for this market, 8:30 Eastern time. Equities going into it a little bit softer. We're down 0.1%. Bonds totally unchanged now on a 10-year maturity. That yield 428.41. Under surveillance this morning, Powell remaining patient.
We want to be more confident that inflation is moving on a path sustainably down to 2%, not at 2%, but on a path sustainably to 2%. That's the test we've articulated. I have some confidence, as I said earlier, that we are on a downward path. I think if you look at the data, it's pretty clear that, but we have not said, though, that we have sufficient confidence, and that will be a decision that our committee makes.
So here's the latest. June CPI data due out less than 1 hour from now. Our survey calling for another month of soft gains. Deborah Cunningham of Federated Hermes saying the Fed would have to see a plunge in the labour market and inflation to give it reason to move in September and risk looking politically motivated. By a slight margin, we anticipate 2 cuts to come in the fourth quarter after the election. Deborah joins us now for more. Deborah, wonderful to catch up with you. We have to start with that point then. Why you think the politics is so important to the decision on the horizon?
Well, certainly that's not where the Fed likes to focus. It's timing decisions. But having said that, if it's, kind of a 50-50 or one that could be biased in either direction, I think they'll pick the direction that has less potential political implications, which would be the November meeting, not the September meeting. The risk in that, though, that I see, Jonathan, is if they moved in November and December, I don't think that sets the stage for an every meeting move expectation in 2025. We're looking at 2025 as something that's maybe 100 basis points in cuts, depending upon what happens from inflation, what happens with employment, what happens with GDP. But I do feel like November and December might risk the thought in the market being more than that 100 basis points, more than every other meeting. And I think that's another struggle that the Fed may be, sort of deciding around that decision in the coming meeting.
Deborah, just to cut that up into 2 different calls, 24, ultimately what I'm hearing are political considerations. 25, can we get into 2025? What's the dominant factor behind the call for 25? Are you expecting inflation to stay somewhat stickier than some people might expect? Are you looking for employment to hold up a little bit better? Where does it come from?
I think you see weakening employment, but I don't think you see it falling off a cliff. And I certainly think we've now, sort of pivoted from a Fed standpoint to looking at both the employment picture and inflation. For the most of the last, maybe year and a half or so, inflation has been the name of the game. Where inflation goes is where the Fed has been, dealing and looking at, to decide from a perspective of what their next moves will be. I think employment now comes into that picture. So inflation below 3%, even if it's 2.9, I think that is considered a confidence level for the Fed. And I think that gives them a little bit of motivation, that it rounds down to 2. And so it's enough. And ultimately, a labor market that rather than 200,000 jobs a month is slowing to something that's more like 100,000 jobs per month is, again, something that they want. So those are the achievement goals that I believe they're looking to get to in 2025. And if they do, I think, rather than 5% interest rates, 4% interest rates or high 3s makes a whole lot of sense in that scenario.
So let's talk about the market call on the backs of not just when they start the rate cutting cycle, but how deep it goes. We've had a number of guests come on the show and say as soon as the Fed starts cutting rates, that's going to unleash some of the $6 to $7 trillion in money market funds into other asset classes, whether it's longer duration bonds, whether it's stocks. And that's actually one reason why they're starting to broaden out their investments. As someone who watches these money market funds every day, how high is that bar for that money to go elsewhere?
Well, first of all, Lisa, I think it's not the lion's share of the cash flow that has come into the product. The lion's share of the cash flow that's come into money market funds over the course of the Fed rate hiking cycle and now stability cycle has been from the deposit product, out of deposit products and into money market funds by retail. That's very steady cash. That stays where it is. That's been 80% of the cash flow. The other 20% has some institutional associated with it, but also has some let's hang out in a safer market and earn 5% type of cash flow in it. And I think that's the portion that will start to move in earnest once the Fed makes its first rate cut. I don't think it's a huge lion's share, but I think it's probably in the neighborhood of 10% maybe of the assets of the product. And it will likely be offset to some degree by institutional cash customers starting to pick up and increase their allocation to money funds just simply because they lag. So the wall of cash, as it's been called, I think is there, but in a way that's much more muted than what the market oftentimes refers to it as.
So are you saying that there's about $600 million of cash on the sidelines when you take a look at what could potentially start moving around? Not $6 trillion, as some people would say.
Exactly. That's exactly what I'm saying.
At this point, there is this issue of how much this is a feasible investment, even at, say, 3%, even at 3.5%. I mean, essentially, how much is this transforming the whole concept of a money market investment at a time where we're seeing rates that we haven't in a very long time? And people are kind of accepting that and starting to move more significantly.
I do think that, we're looking at something that doesn't go below 3% unless there is something in the marketplace in 2025 or 2026 that is completely unexpected and, sort of out of control of the Fed. In the way that they deal with that is by taking interest rates lower than that. So I think in a normal environment with a normal course of business in the U.S. as well as, globally, you end up with a rate environment that's sticky in that 3 to 4% area, and that still represents pretty good value from a cash investment standpoint.
Deborah, wonderful to get your views, as always. Deborah Cunningham there at Federated. Let's sit on 2024. Political considerations for the start of that rate cutting cycle. Over at Federated, they think November. They don't think September.
They think the bar is a lot higher to go in September so that they don't look politically motivated and that you have to see a more significant deterioration in the labor market to get the Fed to really have some conviction behind that call. That's not consensus. Markets right now are pricing in more than a 70% chance of a September rate cut. And a lot of people are saying that the tone that we heard from Fed Chair Powell during the 2 days of testimony would suggest he's softening to that view. So it's sort of this compelling moment where there's just a lack of clarity all around.
Why is November a better time to go? Same week as the election. Why is that a better time to go?
People could say that it's because you're not necessarily trying to put your thumb on the scale ahead of an election, that you're not trying to juice, say, market action ahead of the election. That's what I would say.
I think you get criticized no matter what they do.
Hey, look, I agree with you. I mean, Jay Powell has been sort of a lightning rod for everybody's angst about inflation and frustration with market activity that doesn't seem to cohere with a sort of set narrative. And the reality is, he has been consistent in saying we're just looking at these metrics. We can speculate, though, all we want.
Tune in throughout this morning for more criticism from select guests coming up in the next hour or so. Brent Shooting of Northwestern Mutual. We'll catch up with David Kelly of JP Morgan Asset Management, Steve Risciuto of Mizuho. It's the big one for this market. CPI is just around the corner. The time, 8:30 Eastern time. The question, will it unlock, keep the door open, wide open, for a rate cut in September? After that, the focus turns political. 5:30 Eastern time, a news conference in Washington, D.C. with the President of the United States. From New York City, this is Bloomberg.
Just looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. So how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
At the end of the day, what's going to drive the Fed in the next 3 months to September is inflation.
The hope would be, of course, that rate cuts would be forthcoming. We do think that that's going to happen and that inflation will moderate.
You can't really signal that rate cuts are coming until they get at least one more good inflation report.
I think what will cement September is really another round of data and, more importantly, what we see in terms of the inflation data.
They're planning to cut. They are reluctant to cut because they know how insidious inflation can be.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now. We're 30 minutes away from the big one. CPI data just around the corner. Your S&P 500 so far on the longest daily winning streak of 2024. 7 days. Can we make it day 8? Equity futures negative now by 0.1%. Chairman Powell's assessment of inflation at the moment in his own words. The question is, are we sufficiently confident that it is moving sustainably down to 2%? His answer, I'm not prepared to say that just yet.
Will he be prepared after, in half an hour today, when we get CPI, if it does come in below expectations or even meets expectations, is that enough to give him sufficient confidence to move in September? It seems as though the market is sniffing that out. It seems like that's what the market was buying yesterday. Will they be able to complete the trade today?
Another data point at 8:30 Eastern Time. It's not just CPI, it's jobless claims as well. The confidence they're lacking over the inflation outlook, will it be replaced by worries on the outlook for the labour market? And this is a key feature of the conversations on Wall Street, particularly over the last couple of weeks, last couple of months, with inflation go into the back burner just a little bit, relatively speaking, and we're starting to focus on unemployment, starting to inch higher, jobless claims starting to break out. We'll see where all this stabilizes, but that's one to watch at 8:30 Eastern.
Especially because people don't have a lot of confidence about whether we're getting an accurate metric around this labor market. This has been an incredibly difficult labor market to understand, given the influx of immigration, given the post-pandemic trends, given all of the retirement and boomers kind of leaving and then other people getting hired. Nonetheless, if you see a market increase in weekly jobless claims, that will shift the conversation possibly even more than a CPI print that comes in line or even slightly above.
And cheat code in Washington at the moment, if you don't like the June CPI print that comes out at 8:30, just ask for another June CPI print.
Okay, come on.
Isn't that what they're doing in Washington now?
Is that what they're going to do?
Basically, in Washington, that's what they're doing.
Is that your true CPI print? Is that how you
We're
really
waiting for the June CPI print. We can do this all day. You know, the president comes out and says, I'm the nominee, I'm running, I'm staying in the race, I'm not stepping back. And then the former Speaker of the House, Nancy Pelosi, comes out and says, we're waiting for his decision. We're waiting for his decision. And she wasn't the only one to do it yesterday. We saw this repeatedly. It's ridiculous.
Well, maybe he's still considering it. Is that really how you want to calculate owner's equivalent rent? Is that really how you want to understand inflation, Jay Powell?
Is that your decision?
Is that your decision, actually? No, look, to your point, there is something going on which raises the question of whether Joe Biden is actually actively considering stepping down. Basically, all of these people have come out and said, no, 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 no. What is leadership going to do if they are concerned about how he performs later today?
5:30 is the later today in that news conference. Anne-Marie will be a feature of that conversation. We hope she'll be in the room. We'll catch up with AMH in about 40 minutes. Just to go through the news conference, I think we all want to know, for the reporters in the room, is this going to be 90% on his health and 10% on NATO? Is it going to be 5% on NATO, 1%? I don't know. I'd actually like to see the sitting president talk about substance, real substance, things happening in the world, talking about how cogent he is, how fluid that conversation might be, and not just have this sort of shouting match about the health of a sitting president sitting at a podium in front of a bunch of journalists that feel very scorned right now and hurt by the last few weeks.
I agree with you. I think especially at a time where Vladimir Putin is meeting with the leaders of India, with the leaders of Russia, there's this real question, a pretty punchy communique coming out of NATO leaders talking about China and their aid to Russia in the war against Ukraine. These are things I want to hear him speak about. No one's going to ask him particularly, and if he does, that probably won't be what we necessarily are talking about tomorrow. It raises a larger question about how much NATO leaders are looking to him for that kind of guidance and leadership that the U.S. has traditionally taken, or whether they are not, whether, as reports are saying, they are going to some of Donald Trump's advisors to try to get a sense of what he would do in certain situations. It highlights why this is the main story, even when it comes to NATO.
So I think it's somewhat pragmatic to talk about some of the advisors to the former president, just in case the former president comes back in November, wins in November, returns next year, and that's the government you've got to deal with. So I would say that. On your point, though, I think for those leaders, I can't imagine how frustrated they would be flying into Washington to have a conversation as NATO leaders gather with two wars taking place right now that the world are all looking at. One is in Ukraine and the other is in Gaza. The issue that I would have as a global leader would be of great disappointment that the only thing we're talking about is the health of the sitting president and whether he's going to remain in the election in November.
And what time he's going to go to bed. I mean, these are not things that you necessarily want to be focused on, where there's some very serious issues that they should be discussing.
Coming up on this program, this is the lineup for you. We'll be catching up with Brent Schutte of Northwestern Mutual on recession risk. We'll catch up with Brent in just a moment. David Kelly of JP Morgan on why he's keeping an eye on the unemployment rate. We'll catch up with David in just a moment. We need to talk about these Delta numbers as well. Sort of price sensitivity starting to come to the surface. Delta down in the pre-market and down quite hard. Then we'll speak to Steve Rasciuto of Mizuho reacting to today's inflation report out in about 25 minutes' time. We begin with our top story. It is June CPI data out at 8:30 Eastern. Brent Schutte of Northwestern Mutual Wealth Management saying this: it's a race to see which cracks first, inflation or the economy. And if it is inflation, can the Fed cut rates fast enough to keep what appears to be a weakening economic backdrop from pushing further down and ultimately into a recession? Brent joins us now for more. Brent, wonderful to catch up with you, buddy, as always. I'm going to ask you your own question. What cracks first, inflation or the labor market, the economy?
I think, unfortunately, they crack together. And so to me, when you see these weakening CPI reports over the past few months, you have to think about what's happening behind the scenes. And you are seeing a weakening economy. You're seeing the services side of the economy importantly come down quite a bit. You've seen the ISM services negative 2 of the last 3 months. You mentioned Delta in the pre-market. Look, things are moving lower in the economy. And historically, the Fed has been able to cut rates before the recession actually occurs, but it hasn't stopped it from occurring. And I don't think this time is going to be anything different. And I'm really interested in those jobless claims because, as you mentioned in your opening, the labor market has weakened quite a bit, and it's a confusing stew, but if you look at it, the unemployment rate is up 0.7 from its low. The SOM rule, which we all talk about all the time now, is 0.1 from hitting, and 22 states have actually already violated it, which has never occurred without a recession occurring.
Brent, if we trigger the SOM rule, I'm really intrigued by this question. I don't hear the urgency in the communication coming from the Federal Reserve around this issue. I don't hear it from Claudia Sahm herself. Brent, I hear it from market participants. How do you think market participants, how will markets respond to that data if we climb another, say, 10 basis points on unemployment?
Yeah, we seem to be in a period of suspended disbelief where investors don't believe things that have worked in the past will work again because they haven't so far yet. And so if you think about LAI, you think about all the different indicators over the past few months that have pointed to recession that haven't worked yet. I think many people are shrugging them off like they do at the end of every economic cycle that I've lived through. And so to me, it's a normal behavior that we're seeing what we're seeing. And that's where I think there's a bit of a risk because I think investors have largely ignored those signals. And I don't think it's so odd they haven't worked this time. I think it's just taking longer because the consumer, businesses were so filled with excess savings and had pretty much steadied themselves against rising interest rates. To me, the longer rates remain higher, the greater the risk of recession as the lagged impact of those rates continue to work their way into the economy. And I think you're seeing that in the low-end consumer, you're seeing that in some weaker parts of the economy, and now it's seeping up into the higher end and even into the services side, which has been holding up the U.S. economy for the past, 2 years.
At a time of confusion around which metrics to actually look at and which are actually still accurate, Mohamed El-Arian has come on this program and said, just listen to what the companies are actually saying. We got 3 earnings reports so far this morning. We got Pepsi, we got Delta, and we got Conagra, which is the brand that also has Slim Jim and Orville Redenbacher and other sorts of common consumer brands. Is this a signal to you that this is just a margin compression story, or this is a true concern about consumer appetite and willingness to keep spending?
I think it's each. And so to me, if you see consumers, they're hurting a bit, especially at the lower income levels where credit card delinquencies flows into those are at levels that exceed the past 2 recessions. And so you're seeing it there, and you're also seeing margin compression because companies can't raise prices as much. At the same time, compensation is still elevated. Yes, it's come down like Chair Powell talks about, but it's still not where it needs to be for inflation to be sustainably at 2%. And that's where I think the issue is on both of those metrics, and that's where I think markets are in for a bit of a awakening in the next couple months.
You wrote that there are a lot of hopes baked into equity markets that need to pull back in the shorter term before we get more interested in large caps again, kind of speaking to some of the overenthusiasm that you're seeing, at least in markets. Can you quantify that? Give us a sense of how much of a pullback and where you would need to see it to once again re-engage with the market?
Yeah, it's not that we're out on the market. And actually, my positioning is a bit interesting given my outlook. Look, I think there are parts of the market that have actually already discounted some sort of recession. And so if you look at the S&P 600, it trades at 8.1 times the trailing 12-month cash flow. If I go back in the last 26 years, the only time it's traded there is coming out of a recession. And so to me, this is where it's interesting. And Lisa, we used to talk about risk on, risk off on the show when I came on, and risk off meant buy bonds, risk on meant buy stocks. Today, risk off means buy the Mag 7, risk on means buy the other 494 companies plus the mid cap and small cap sector. And so to me, I think investors have already discounted that. They've been hiding away in quality where earnings have actually grown. I think the biggest question going forward is how much do you pay for the Mag 7 and can those earnings grow forever, which I think is a question that I've seen asked a few times in my history of doing this. And I think the answer is probably likely to be not. And so I think there are opportunities in things that are ironically economically sensitive. Doesn't mean they won't go down. But I do think there are opportunities for investors that I steward, which are more intermediate to long-term focused, to focus on those areas of the market that are underloved right now.
Just to get some additional clarity, Brent, are you suggesting that this market is actually quite well priced for the economic downturn you're anticipating?
No, I think there will still be a falter in the markets overall because I think investors are similar to what they have been in the past where they panic even though they shouldn't and they know they shouldn't. But I do think if you think about 1999, you take a look at those charts on your Bloomberg, small cap and mid cap actually did okay going into that recession. It was the stocks that had been up on the belief that they were economically impervious and tied to some longer term investment theme that didn't do as well. And then coming out of the recession, the next 5, 6, 7 years, those parts of the market that were underloved, value stocks, small cap stocks, mid cap stocks, actually performed quite well. Even the equal weighted S&P 500, which we have a position in, performed quite well. And so I think there's good news to go along with the concerning news of a recession. And that's where I think I'm still optimistic longer term. It's just that I'm a little bit more cautious in the near term because I'm seeing evidence of investor over-optimism.
Yeah, this is the challenge I think a lot of investors have got right now, Brent. Should I position for the recovery to the recession we still haven't had? You know, what do you tell them if they ask you a question that sounds a little bit like that?
I don't think you could time anything perfectly. I don't know when a recession is exactly going to happen. I do believe that we're later in a business cycle. I think the evidence there is pretty strong. I don't believe the Fed has ever taken an out of slack economy to a slack economy that has slack without unfortunately causing a recession because they do focus on the lagging labor market indicator. And so to me, I do believe there will be a downturn. I don't think you're going to be able to time it perfectly. And so that's why I want to continue to own those things that are economically sensitive, that haven't done as well, because I believe the opportunity set on the opposite side of this is so large that I don't want to miss it.
Got it. Brent, appreciate the clarity. Thank you, sir. Brent Schutte there of Northwestern Mutual. Some similarities in that conversation between what Brent said and what we heard a little bit earlier this morning from Russ Kostrick of BlackRock, which is I want to be in equities, kind of for what the same reasons that Brent just described, but ultimately, where do I want to trim? Some of the high flyers, some of the big names, and we know what those names are.
Even if in the short term there might be an underperformance of some of the other 493 stocks, there is this feeling that they have more upside than some of the Magnificent Seven, especially if the Federal Reserve cuts rates and allows them to borrow at more reasonable prices. And that's some of the thesis that we're hearing in an increasing number of guests.
Delta cares about the economy and NVIDIA doesn't. That seems to be the conclusion. What Brent said there, the question he's asking, is that a mistake? Is that a mistake? If you go down into an economic downturn, just how economic sensitive are these so-called secular growth themes? Do we find out they're more sensitive than some people thought they were?
We will if we find out that artificial intelligence isn't necessarily applicable in this sort of quick and easy way that actually is a game changer across a swath of companies. Yes, maybe in some, but if it's not in the same kind of game-changing way quickly in the others, it might be more sensitive just in terms of how far that demand can go.
If you are just joining us, welcome to the program. Equity futures slightly softer. We're down 0.1%. In 16 minutes' time, we get CPI data in America. Before we get to all of that, let's get you an update on stories elsewhere with your Bloomberg brief. It's Danny Berger. Hey, Danny.
Hey, John. The Biden administration is taking more steps to support the American EV industry. The White House is awarding $1.7 billion to at-risk or closed auto manufacturing and assembly facilities across 8 states. The plants would then be converted to support clean vehicle manufacturing. Stellantis plant in Illinois and GM plants in Michigan are 2 locations, each set to receive over $500 million. The awards are subject to negotiations and other reviews before becoming final. And a check on PepsiCo shares in the pre-market this morning, down by nearly 2%. It reported second quarter profit that beat expectations, yet revenue did come up shy. Organic revenue in the second quarter rose 1.9% versus a 2.9% estimate. Demand is slipping after consistent price raises from PepsiCo, especially in North America, where revenue and volumes dropped year over year. Prices for the most in-demand luxury watches slipped on the secondary market last month, extending a 2-year decline. The Bloomberg Subdial Watch Index fell about 1% in June for a total decline of 8% over a year. Bad news for speculators who'd been snapping up watches, betting that it could beat other asset classes. Yet the S&P, for its part, is up 27% over the same time period of the past 12 months. The only brand to have gained among the 50 most traded watches in the second-hand market was Cartier, up 2% in a year. And that's your brief, John.
Danny, thank you. If I had a Patek or an AP, I'm not sure I'd wear that in public in New York City. This is some of the thefts taking place.
I've heard about this, and I've heard about how it's happening in a whole bunch of different places. It has been a problem in a lot of companies. A lot of restaurants are saying they're trying to install more security, more cameras. How do you even protect your staff, some of whom have been injured during some of these thefts?
Yeah, it's kind of shocking, arriving on mopeds, seeing it outside the restaurant, seeing some thefts taking place inside the restaurant as well. Let's park that story there. I want to talk about this one just briefly. Delta's getting hammered, like absolutely hammered in the pre-market. We're down by 9%. It's spilling over to the rest of the industry. Look at the other carriers. American's down almost 5%. United's down 4.7%.
This, to me, really highlights the question of, are we seeing cracks in the industry that arguably was supposed to benefit the most from the new trends, the post-pandemic experience economy, at a time where those numbers have shown strength? Why are we not seeing the profitability? Is this the beginning of margin compression? Is this consumer pushback? Or is this just a matter of cost-cutting around the board at the Paris Olympics?
We'll keep following that story as people sort of question whether we should be going to Paris this summer. Is that what you're doing still?
Well, I guess I'm trying to kind of put that together, because I would think that more people would fly to Paris to see the Olympics. And then if they don't fly to, then maybe it's a good time to
It's
go.
an odd excuse. I mean, you know, that can't be the only reason. It's not the only reason.
Well, I want to dig a little bit more into that.
Dig deeper, Bram.
Okay, well.
Up next on the program, the Morning Calls Plus. David Kelly of JP Morgan counting us down to CPI data in America. That data just around the corner.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It down to two things this morning. The opening bell 1 hour and 10 minutes away, and in about 10 minutes time we also get CPI data for you. Going into it, the scores look like this. In the equity market on the S&P 500, we are down by 0.2%. Yields are just about unchanged on a 10-year maturity, south of 430 at 428.61. It's time now for some morning calls. First up, Rosenblatt Securities raising its price target on Broadcom to a street high of 2,400. The analyst seeing strong prospects for the chip maker, including upside from ongoing AI trends. Your second call from Darden Restaurants cut to underperform at Jefferies with a price target of 124. The analyst saying the Olive Garden parent could lose share thanks to rising promotional intensity in the casual dining sector. We're down by 1.6% there. And finally, Baird raising its price target on Costco to $9.75 from $8.50. The analyst highlighting the chain's membership fee increases, providing more oxygen to support Costco's lead on foot traffic and market share gains. That stock is up by 2.4%. June's inflation report is just around the corner. You all know that. Core CPI expected to rise 0.2% for the second month in a row, marking the smallest back-to-back gain since August. With us around the table, David Kelly of JP Morgan. David, good morning. It's good to see you.
Glad to be here.
8:30 Eastern time. We're all looking for CPI maybe to come in a little bit softer, leave the door wide open for a September rate cut. Do you see things quite the same way?
Yes, I mean, it's a dangerous game to play, this consensus game, because we could easily miss by a tenth one way or the other. But overall, the year-over-year CPI inflation rate, we think will come down from 3.3% to 3.2%. And it's just a steady decline. I think it keeps on falling on a year-over-year basis until about September, and then it sort of stalls out a little bit. So it is coming down, but it is, as you know, we've talked about for a long time, just coming down slowly. So that's one part of the story. The other part of the story is we are seeing a more notable shift down in the pace of consumer spending growth. And so some of the data from the last few months on retail sales and on auto sales, some of the science and for credit card delinquencies, they are saying the consumer spending is growing more slowly. I think the Fed is looking at that too. So a little less inflation, but also a little less growth.
So are you saying that the disappointments that we've seen in the forecast from Conagra, from Pepsi, from Delta, the sort of downgrade of Darden companies, the idea that maybe the breadsticks aren't really doing it at Olive Garden, there's this question of whether that alone should be sufficient, in your view, for the Fed to cut rates, and maybe even will be sufficient?
Yeah, and I think it will. I mean, first of all, last year I seem to remember Chairman Powell saying, if we've got inflation coming down towards 2%, even if the economy is still okay, we can cut rates, we can normalize rates. Now, we're not headed for, I don't see any reason why we should be headed for recession here, but we are seeing that slowdown growth, we're seeing inflation. This number today should be consistent with a 2.5% year-over-year change in the consumption deflator. That's close enough to 2 as far as I'm concerned, given the trend we're on here. So I think there's a perfect reason for the Federal Reserve to normalize rates, and I think he sort of hinted at that in his testimony this week.
When you say normal, what is normal in this particular regime? What does it look like?
I think normal is higher than the Fed says. The Fed says that in the long run, the federal funds rate ought to be about 2.8%. I think it's higher than that. I think you take that 2% inflation rate, you add on close to 2 percentage points, so you get to about a 4% Fed funds rate, 3.75 to 4. I think that's reasonable. So to me, that's normal. And what's happened is right now we've got a restrictive monetary policy, which is not doing that much to the economy, but it is kind of messing up financial markets and adding some risk to certain parts of financial markets. So I think just normalizing back down to 4% and then holding until the Fed actually has to do something one way or the other would be the right way to go.
Equity markets at all-time highs going into this print in about 7 minutes' time. Mike McKee's with us to break this one down. Mike, you're going to break down the number when it drops. Give us the preview. What are you focused on? And what do you think Chairman Powell needs to see in this particular print to gain that additional confidence he needs, the committee needs, to reduce interest rates?
Well, it's unlikely that we're going to get a huge downside move, but if we do get the slight downside move that economists are forecasting, that'll keep the Fed on the path to September. Within the report, they're going to be looking at the things that have surprised in recent months, and of course, housing. Housing, according to Omar Sharif of Inflation Insights, could come in at its lowest since 2021. After some months of waiting for this to actually happen. And then you want to look at airfares. I know you're talking about Delta and others this morning, and insurance. That's been a big part of this, is what's happening to auto insurance and home insurance. It's going to be interesting to see what happens post-hurricane with home insurance, but right now it looks like we're seeing a sort of reversal of trend.
Mike, which is more important, jobless claims or CPI?
CPI.
Okay.
Jobless claims is a great contemporaneous indicator, gives us an idea of where we are, but it doesn't necessarily tell us how good or bad the labor market is, other than in broad general terms. But CPI is going to give the Fed actual clues to where inflation is and probably where it's going.
Mike McKee, thank you, sir. Mike's going to be back with us in about 5 minutes. Great question. Great question. Because some people out there might have a different opinion on that. It might be the labor market taking center stage.
It depends what the numbers are. If CPI comes in line and all of a sudden jobless claims goes to 280, all of a sudden you'll have a very different point about which was the more important number. And I think that is the balance that people are kind of making.
What did Citi say? Danger zone was something like north of 260?
Exactly. And
something like that.
We're creeping toward that.
The estimate for today, 235. The previous week, 238. The numbers drop in just a moment. CPI is just around the corner. The latest inflation read in America, together with those jobless claims numbers. To break it down, Mike McKee, Steve Rashuda of Mizuho, and David Kelly of JP Morgan Asset Management. Fantastic lineup to react to the latest big economic data point in the United States of America. That data drops next.
authorities.
Could face bigger challenges. Britain's next.
Was going to keep reading World Cup. This is a 3.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The economic data just around the corner. It is 20 seconds away. Jobless claims, CPI, and a whole lot more to focus on. Mike McKee's going to break it down. These are the scores going into the data. We're down by 1/10% on the S&P 500. In the bond market, yields on a 2-year, 10-year, 30-year look a little something like that. 2's unchanged, 462. Right now looking at 10s, 426.65 with the data. Here's Mike McKee.
Well, John, good morning. And it looks like we are remaining on the path to September. CPI headline comes in down 0.1%. The forecast was it would go up by 0.1%. And core comes in up just 0.1%. The forecast 0.2. So some real progress there on CPI. The Fed is going to be glad to see. On a year-over-year basis, the CPI is at 3%. And the core is at 3.3%. So a lot of good news in the inflation headline numbers. In terms of jobless claims, 222, we go the other way. Instead of the crisis level, we're going back to where we used to be. Continuing claims, 1,852,000. So I'll take a look at the underlying data, and I'm sure you're getting a market reaction today.
Yeah, you can guess in which direction. Mike, thanks for that. Mike, we'll come back to you in just a moment. Double-digit decline at the front end of the yield curve. So let's talk about that. A double-digit basis point decline. We're down 11 basis points on a 2-year. We're back to 450. On a 10-year, we're down 10 basis points. It's a break of 420 at 418. Once you've seen moves like that in the bond market, you know what happens when you push it through foreign exchange. You've got a weaker dollar, a stronger euro, and I think you can guess where equities are right now. Let's check it out. The S&P 500, the NASDAQ, firmer, the winner, the outperformance from the Russell, up by 1.3%. Lisa, based on this data, and we can talk about whether we should extrapolate it out through the rest of the year or not in a moment. But based on this data this morning, it's the best of both worlds. Jobless claims come in a little bit better, downside surprise on CPI.
Is it Goldilocks redux? That's kind of what I was thinking when I was looking at this, given the fact that jobless claims went in the opposite direction. I will say that the previous week was revised upward by 1,000. Not anything dramatic, though. That said, how much can you really glean Goldilocks from something that is just like a blip in the moment? At the same time, you could see how it's being translated to the market. If the Fed cuts now, it would be a dovish cut. It would be a positive kind of view on a market, a mid-cycle adjustment that would allow equities to keep rallying. That seems to be the tone.
That's the kind of rate cut the equity bulls want to see. Mike McKee, I'm going to come back to you and use the words of Chairman Powell. Repeat them again. The question is, are we sufficiently confident that it is moving sustainably down to 2%? I'm not prepared to say that just yet. After these numbers, would he be prepared to say that?
He might be. It'll be a lot harder to say that we've got a lot more work to do, given the way some of these numbers are breaking down. Of course, we saw a big drop in gasoline prices. That continues, and we've seen oil prices go down, especially with the IAEA report. And that is a big part of what all this is. But the biggest thing is housing, and housing has finally gotten into the area the Fed has been expecting for a long time. Owner's equivalent rent up just 0.3. That is the lowest since the fall of 2021. Rent of shelter up just 0.2%. Rent of primary residence 0.3. So a lot of good news there. We also see that lodging away from home fell by 2%. It's interesting because this is the time of year when the tourist places like where I am would be full. And so lodging, it was a little bit of a surprise coming down in June by that much. I'm still looking here to see motor vehicle insurance is what I'm trying to get to here, because that's a big deal. New cars and trucks prices, new cars down by 0.4, and used cars down by 1.5%. So all of that continues to be the kind of thing that we're looking for.
Mike, I find it fascinating that when you look at the futures markets, you actually see the chance of a September rate cut go down after these numbers came out, that it was actually higher yesterday at almost 75%. And today, it's below 70% in the wake of these numbers. How much, if doesn't seem like the labor market is cracking, how much will patience be the operative word for the Federal Reserve, even at a time where inflation is coming steadily down?
Well, you have to think that they are not going to rush into it, and my guess is they would not rush into July, but we could get a really soft PCE print. And then you want to look at what happens with the spending numbers, retail sales next week, and PCE spending at the end of the month. And if they get an indication that the economy was cracking, then they might go in July. But this really sets up the opportunity for them to start talking about September, getting the market priced for that, and basically saying we're on the path if the economy continues to develop the way we think it is and the way that we're seeing. Jobless claims today don't give any indication that we're going to see any kind of major drop-off in the economy, though.
Mike McKee, thank you, sir. Mike, we'll come back to you in about 10 minutes' time. Stay close. If you are just joining us, we'll start with the data, and then we'll bring you the price action, the reaction to that economic data. We'll start with headline inflation month over month, CPI coming in at negative 0.1%. The survey, the median estimate in our survey here at Bloomberg, positive 0.1, so that's the right kind of downside surprise. Stripping out food and energy month over month, we come in at 0.1. The survey, we were looking for positive 0.2. That's the economic data for CPI. For jobless claims, we were looking for 235. That came in with the right kind of downside surprise at 222. So the jobless claim picture, a little bit healthier. The inflation picture, leaving the door wide open for this Federal Reserve to consider making a move. So you can guess what's happening in financial markets. We'll start with equities, then turn to bonds and go to foreign exchange. Equities rallying, futures up by 0.2. We've had 7 days of gains on the S&P 500 already, the longest daily winning streak of the year so far. We might add some weight to it. And the Russell, Lisa, that's where your outperformance is. The Russell, the small caps, up by close to 2% in early trading.
And this is exactly what Brett Schutte was talking about, that essentially if you get some sort of cooling in the economy in any kind of way, those rate cuts are going to bolster the areas of the market that haven't necessarily seen some of the gains to date that have been commensurate with what we've seen in big tech. Look, it's just one set of data, but this would talk about the soft landing that Fed Chair Jay Powell says that he stays up at night worrying about landing. This is what they want to see. Do they see a rate cut as helping perpetuate this type of dynamic?
Push it through the bond market, 10 basis point move at the front end, the 2 years down to about 452, the 10-year earlier breaking 420. We're at about 419 right now. We're down 9 basis points on a 10-year yield. You push that through foreign exchange. We talked about this briefly. You've got a weaker dollar against a stronger euro. Euro dollar looks a little something like this. We are firmer on that currency pair, close to 109, positive by 0.4%. With us around the table, Steve Rasciuto of Mizuho, still with us, David Kelly of JP Morgan Asset Management. David, just got this from Neil Dutta of Renmac. The Doves have what they need. It's time to cut. Get on with it. Do you agree?
No, I think they should go in September. I think they just need to be steady as they do this, because if they rush it, it's going to actually look like they're scared about something. And I mean, I don't think they should have gone this high in the first place, but now they're here, just let's take it down easily. So I still think September, December, March, June, September, December. 6 rate cuts, 1.5 years. I think that's what they should do.
Powell in Sintra, Portugal, said a strong labour market gives them some time, the luxury of time. Do you think he has that time as well?
Yeah, I think so. I mean, there could be some cracks in private credit. There could be some cracks in regional banks. I mean, we are concerned about things that are not set up for normal interest rates. But remember, long-term interest rates are kind of at normal levels here. A normal business ought to be able to operate here. So I think it's, if it slows the economy a little bit is by not accelerating this, okay. But I would rather they take their time and not rush this, because once they start rushing rate cuts, then it's going to scare people.
Steve, what's your impression? I know that you've been on the maybe they shouldn't cut at all. What about given how much inflation's come down?
again, you've had an inflection point in the economy. We went from 3.3% last year with an economy that was clearly growing too strong and inflation was not going down. You had a shift to a slower growth economy this year, 2.2, 2.3%. You've had some benefits of that in terms of a higher unemployment rate, a lower level of inflation. Is the economy going to stay a trend, or is it going beyond that? That's now the question they have to answer. They also have to worry about the risk, because as David mentioned quite clearly, the concern is if they move too quickly, the expectational set in the market could get ahead of themselves. You know, you've already seen one or two strategists on the street saying they're going to cut rates 8 times next year. So you've got this environment where if the market goes too far, they then have to think about, will they then have to reverse policy? So the dots have kind of put them in a bit of a tricky box for themselves. So they really can't do a hawkish cut. All they could do here is do a cut that fulfills the dots, and the markets are likely to go well beyond that.
Okay, pause. This is something that people used to talk about. We have just gotten 37 record highs on the S&P 500 this year. Why is that not potentially problematic enough for them? Why is that welcome? You think it should be?
It should be, but this is a different Fed. You have to take a look at the people at this Fed. These are a bunch of political economists. They're not the old school anti-inflation hawks. The political economists want to play with the levers. They've written their dissertations on playing with the levers. They want to play with the levers. They're going to play with the levers. We're not arguing about if, we're arguing about when and how the market will react to it. They think that they can control the market's behavior, and to a certain extent, they've done that. And they've gotten a great hand, let's be honest. They're getting everything they want. The economy looks as if it's slowing. The labor market looks as if it's coming back to normal. Inflation looks as if it's coming down. To me, this is a winning hand. Why would you toss it out by doing something stupid in July? You wouldn't. You'd sit back and wait.
The other thing about, you know, if there are parts of the markets which are over-exuberant, it is entirely the fault of the Federal Reserve for going 10 years with rates at 0. I mean, if you make the carrying cost of crazy 0, then people do crazy things. And so we saw that. Then we got momentum going in Bitcoin and meme stocks and even the Mag 7. And what's happening now is you've got a stable economy and people just doubling down on the bets that have worked. But we want to see more fundamental investing rather than momentum investing, but they've sort of caused this momentum investing environment by keeping rates so low so long that you could get all these irrational bets going. And now the problem is, well, how do you get out of that? And I think you just return to rational interest rates, which makes sense based on the economic fundamentals, and then over time markets can return to that rather than trying to manipulate markets by moving interest rates too quickly.
Steve, what do you make of that argument, that essentially if they adjust policy that will help some of the names that haven't participated in the euphoria? We're seeing Russell 2000, which has underperformed, actually outperforming at rate cutting expectations, not necessarily NVIDIA.
I think there has been an environment in here in which basically the underperformance has been a function of the fact that earnings for a lot of these companies haven't been good. And the reason why earnings for a lot of these companies haven't been good is because their costs have gone up. And not only that, because of the discount or the slower growth environment that we've seen coming into this year, it's harder for them to pass those prices on, so they're getting squeezed. The question is, what is the next reaction to it? I think the answer is if the Federal Reserve begins to cut interest rates and the market goes very aggressively, which I think the market will do, the market will overstate what the Fed is going to do, because every time they cut, they go to 0. I guarantee you, as soon as they cut, you are going to see zero hedge, and you're going to see a lot of news stories out there about there must be a collapse in the real estate market. There's something going on in the economy. The Fed knows something we don't know. We're going to be talking about 0 levels of interest rates. Once that happens, they're going to be faced with a very different situation. This is why equity analysts have been unwilling to cut their earnings, because they know that basically whenever the Fed cuts, they go to 0. So we're expecting them to cut, we're expecting them to go to 0. So why would I ever cut my earnings numbers? I'm going to have a real bullish economy.
The most dangerous time for the economy is usually when the Federal Reserve decides they're going to help it.
Is this the point that you're making, just on the timing, that they wouldn't go in July because it would spook people?
Yes, I mean, I think there is a cadence. There are 4 big meetings where they put out new summary of economic projections, and 4 smaller meetings where they don't. And I think a cadence of cutting rates at every summary of economic projections meeting, so the September, December, it makes it predictable. And you also get down to, look, our terminal rate here is essentially a normal rate of about 4% or so in the federal funds rate. That's where we're headed until the economy actually, or financial markets in the economy need us to do something. But they shouldn't try and micromanage the economy, and because what they end up doing is causing bubbles and busts in asset prices.
I'd like the view from both of you on the following question. Are there political considerations at play here? Do you think there are?
I believe they try very hard not to interact or make political decisions or overtly political decisions because they don't want it coming back at them. You know, deep down, I know they prefer a government that lets them do their job, because while I don't always agree with what they do, I think we would be infinitely worse if we had people from the other side of Washington telling them what to do. That would only make the situation much worse. So I'd much rather the Fed make mistakes, but they're honest mistakes they make on their own with the best intentions for the country, rather than have the other side of Washington make the decisions for them. Steve?
Well, I think the answer is they want to maximize social welfare. We can argue as to the right way to maximize social welfare. The inflation hawks would say keep inflation at 2% on a sustained level and let the economy find its own equilibrium on the real growth side. This Federal Reserve, on the other hand, wants to maximize social welfare by keeping unemployment very, very low. There's a big difference in the fundamental profile, and that's the reason why I'm sitting here saying it's nuts if they cut interest rates. They run a lot of risk if they will cut interest rates, and they may have to reverse it down the road because they've created this instinctive response in the marketplace. But I also think you have to keep in mind, this Federal Reserve has been itching to cut rates. I think they'd be crazy to go in July. I think it's an open issue as to whether or not we could talk about September. It's always been about not if, but when, and we'll see what the data shows us between now and then.
So what you're just saying is that essentially the most important number for them is the employment number, not necessarily the inflation number. Is that correct?
They don't want to see a rise in unemployment. No, they don't want to see it. Keep in mind, the rise in unemployment we've had today goes back to something David said earlier, which is basically the household employment is dipping and the payroll employment, no, it isn't. The reality is, whenever you re-benchmark these two series, guess what? It's the household employment that's adjusted to payroll. So the payroll is the better coincident indicator of what's happening. So you've had a dip down in household employment, you've had an increase in the participation rate, and the unemployment rate has gone up. You've had very few layoffs, according to that same household survey. So you actually have an environment in here in which people aren't losing their jobs. So to me, the labor market is actually still tighter, and that is what they're paying attention to.
Well, I think it's almost like we've seen a microeconomic change in the labor market rather than a macroeconomic change. Because if you go back to when we hit a trough back in April of 23, if you could fog a mirror, you got a job. And frankly, there are a lot of people in America who shouldn't be employed. And what's happened is, if you look at what's actually happened with the unemployment numbers from the household survey, it's the long-term unemployed that have gone up. And that's really interesting in an economy where you've got 8 million job openings. There are people who after 15 weeks, after 26 weeks, cannot find a job. That's not about the economy. That's about are these people employable? And so I think what's happened is I think Chairman Powell's right. We have actually returned to a kind of normal labor market at 4.1% unemployment. I don't think there's anything wrong with that. I don't think it's a sign of great macroeconomic weakness. I would take issue with one thing, though. I am concerned that the payroll survey may be overestimating things, because when I look at business formation data, it's suggesting that we're creating all these businesses, and if that's feeding into their birth debts model, they may be getting that a little bit wrong, because I think there's a lot of churn in businesses. I don't think this has meant much new business creation as some of the data would suggest.
Just want to offer this up. Fed funds futures have just readjusted to about 85% chance of September. So that sounds like it's a bit more in line with what I would expect, given what we're seeing. I'm curious, Steve, given what you're talking about, how you would see some of the earnings that we got today that indicated a real reduction in consumer spending and definitely less pricing power more broadly.
I think it indicated more the less broader pricing power environment. Again, we're still running an inflation rate well above 2%, even with these numbers. So we're still a percentage point above. And if we're going to say, oh, gee, the deceleration from 3% to 2% is a big movement on growth, okay, the movement from 3% to 2% on inflation has to be considered a big movement still. So we're still, in that environment. So I think that the reality is, when we balance it and we look back at the data in general, we take a look. They're still well above their target on inflation, and they're still maybe at trend growth. Okay, where do we go from here? I think the reality is that you're seeing an environment where cost pressures are squeezing companies. And that's really their problem. And they will, if you cut interest rates and you have a sharp rebound in economic activity, they will pass those price increases along. And when that happens, then it becomes a problem for them. This is why go slow, take your time. You've got a winning hand. Why would you do anything today or potentially September to destroy that winning hand? It makes no sense to me.
I just wanted to know if fog and mirrors was on the job description at JP Morgan. That's all I want to know now.
I wanted to know what he was talking about. Is it that you get close to it and go,
basically, that's how you check if something's actually about the living. You put a mirror up to the mouth.
Okay, thank you.
Catch up.
Thank you, I'm
just
trying.
hoping no new hires at JP Morgan are watching this. David Shudo of Mizuho, David Kelly of JP Morgan, to the both of you, thank you. Gents, just fantastic. Agreeing on something as well for once, too. They can wait. They can wait. Mike McKee's still with us. Mike, I wanted to return to you just because you've had a few more minutes to go over this data. What jumps out for you now?
Well, there are a number of numbers that jump out, but I think the overall thing that is very interesting about this report is how calm so many categories are. It does show kind of a normal inflation, the kind of normal inflation that we had prior to the pandemic. A lot of things up a tenth or down a tenth, not so many huge moves. The biggest thing now is rent, because of course it's 30% of the CPI. The owner's equivalent rent up just 0.3. That's low from the fall of 2021. So some real progress there. The Fed finally seeing what it wants to see. Food prices up just a tenth, apparel prices up just a tenth, airfares down 5%. You can see Delta was getting ahead of the CPI with that release that it put out. But used cars were down a lot, new cars were down a lot. Automobile insurance, the one thing that rebounded from last month's drop, was up 0.9. So basically, it's a very benign inflation report. And because it's broadly benign, I think that gives the Fed a little more confidence that inflation is going to remain under control, because it's just the whole process is coming out as it used to.
And this bond market rallying quite hard off the back of it. Yields drop in. Mike, thank you, sir. Mike McKee there, breaking down CPI, the inflation data, and jobless claims as well. Let's get you an update on stories elsewhere. Let's do that and get the Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John, I do just want to go over those figures one more time. Both core and headline CPI coming in softer on the month. That has sent money market odds for September cut to over 80%. And the front end of the curve, as you mentioned, John, to its lowest since March. The 3.3% annual gain in the core reading is its smallest since April 2021. Only 4 of the 71 economists surveyed had predicted that the core monthly gain would come in at 0.1%. Everybody else was higher. As for the individual components, Mike mentioned some of these, but used cars down 1.5%, hotels down 2%, and airfares tumbled by 5%. Elsewhere, Citadel Securities is crafting a new plan to handle even more of Wall Street's trading, according to people with direct knowledge of the matter. The firm aims to offer a white-label trading service where it manages the guts of a trading desk, like the technology, analytics, and order execution. That would allow struggling banks and brokerages to just focus on dealing with customers. The plan is still in its early stages, according to those people familiar, and could still evolve. Now, shares of the major U.S. airlines all falling in sympathy with Delta pre-market, down by as much as 5%, down by 9% for Delta after they forecast a quarterly profit that fell short of Wall Street estimates. The weaker forecast reflects issues that are plaguing the broader industry. Despite a busy summer travel season, the supply of seats available now exceeds demand, prompting some rivals to lower fares to stay competitive. Delta CEO Ed Bastian saying that price cuts have been, quote, particularly acute for June through August. And that's your brief. John.
Hey, Danny, thank you. Appreciate it. Up next on the program, setting you up for the day ahead. From New York, you're watching Bloomberg Surveillance.
The top names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself. I want to be the one speaking. I have AI myself. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Middle East and Africa, vibrant resources and Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Equity futures look like this, slightly softer now. Those gains don't stick on the S&P 500, they do on the Russell. The small caps up by almost 2%. Bonds still rallying, yields lower by double-digit basis points. At the front end, we're down 10 basis points on a 2-year, 452. Inflation a bit softer. Jobless claims looking better too. As we count you down to the opening bell, here's the trading diary for the rest of this week. Later on, President Biden set to hold a news conference when the NATO summit ends at 5:30 Eastern. Friday brings US PPI and UMich. Plus, we get some bank earnings, JP Morgan, Wells Fargo, and Citi. Looking ahead to that press conference in the room, Bloomberg's Anne-Marie. AMH, tee it up for us. What are you focused on?
Well, it feels very make or break, and this is going to be kind of like the debate, what's more important, style or substance? This is going to be style. Is the president answering clearly? Is he stringing along sentences and not mumbling? How does he act? And how many questions does he take? Everyone is going to be putting this president under a microscope. It feels very make or break for this White House, especially given the fact that yesterday we had one voice come out, first sitting U.S. Senator Peter Welch of Vermont, saying he needs to step aside.
You'll be in the room. You'll be asking questions too. Is this going to be about his health, or will we actually ask questions about NATO, about the wars taking place around the world?
Well, I'm hoping I get a question. It depends how many questions Biden and his team is willing to give out. Is this just going to be very structured, maybe 2 journalists that he's going to call on? Or is he going to do what he did when he marked the 1-year anniversary of his administration and do a 2-hour news conference?
Anne-Marie, down in Washington, looking forward to the coverage a little bit later. What a morning, what a day we've got ahead. Coming up tomorrow to react, Gerard Cassidy of RBC, John Stolfus of Oppenheimer, the NATO Secretary General, Jens Stoltenberg, and a good friend of this program, Mohammed Al-Arian. All of that still to come from New York City with softer inflation. This was Bloomberg Surveillance.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
October of 2019, you surprised the business world by stepping down as the CEO of SAP, a very, very large company whose value had more than doubled during your co-CEO position and CEO position. And you took a position with a much smaller, less-known company, ServiceNow. Usually people, when they leave a job, they go to a bigger company. Why did you go to a smaller company?
Well, I saw the future and where it was going. First of all, I want to say I had a great run at SAP, and it was a pleasure taking them from 39 billion to 163 and really inspiring lots of people and customers, and it was a wonderful experience. But after 17 years, nearly 10 as CEO, I was ready to do something different. And when I saw ServiceNow in the marketplace, I knew what it was, and I knew what it could do. And I knew with my background, I was a pretty good cultural fit for what ServiceNow needed to scale it.
So let me ask you, what does ServiceNow really do? Tell me in simple English language that everybody can understand. What do they actually do?
40% of the CEOs say today, if I don't digitize my operations, my company will no longer be viable in less than a decade. So we were the IT backbone for companies all over the world. How do they manage their assets, run their operations, secure their operations, all things digital having to do with IT.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg.
Less than 30 minutes until the start of trading, and futures are down. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
It's the big story. U.S. inflation cooling broadly in June, adding to a case for a September rate cut.
Plenty of single stock stories and action this morning after Delta's outlook mix. Pfizer's weight loss breakthrough is interesting as well.
And of course, here come the big banks set to kick off earnings season tomorrow. The Wall Street earnings parade beginning tomorrow. But let's take a look at these markets right now. It was interesting. We had that blockbuster CPI print, actually a contraction in CPI month over month. You saw S&P 500 futures spike pre-market, but taking back those gains right now, currently down 0.1%. Same story if you look at big tech. The NASDAQ 100 index currently lower in the pre-market. What is holding on to its gains is the bond market. That 10-year Treasury yield currently lower by about 9 basis points. Matt, just absolutely dropping like a stone.
All right, I'm taking a look at really stealing one of Torsten Slok's charts this morning, taking a look at the number of companies that outperform the S&P over time, and this really shows the narrowness of the market. Only 22% of companies are outperforming the S&P after we've had 37 all-time record highs this year. That's the second most this century after 2021.
And there's some stocks I'm watching, Matt. Absolutely a brutal start to earnings season here. Delta Airlines down now more than 9% pre-market, leading travel stocks lower. Remember, fare discounts, higher costs have offset the number of summer travelers Delta is feeling. One of many stocks to watch this morning in earnings season.
All right, CPI data out as well in the last 30 minutes. Let's get over to Michael McKee, Bloomberg Chief Economics and Policy Correspondent, to give us the good news, Mike.
Yeah, it is good news, and it probably gives the Fed a lot more confidence, Matt, about the possibilities for a September rate cut, certainly giving the markets more confidence. As Katie mentioned, we saw a 0.1% contraction in headline CPI after flat last month, so 2 months in a row of basically no inflation in the overall CPI. The headline goes down to 3.0% on a year-over-year basis, and core, which the Fed's going to focus on, up just 1/10. That's the lowest in some time, and the core year-over-year, 3.3%. Super core comes in down 0.5% after down 0.4 the last time. So we're really seeing some progress against inflation here. The biggest contributors, gasoline, which is kind of always the case lately, and now the IAEA says demand is still falling, down 3.8%. Motor vehicle insurance, the one thing that rebounded, up 0.9%. And this explains Delta. Delta kind of getting out ahead of the CPI, but airfares falling 5% during the month. The biggest story, though, is owner's equivalent rent. The Fed's been waiting for housing prices to come down. They're now rising at the slowest pace since the fall of 2021, and that is going to be very good news for Fed officials who are, at this point, perhaps a lot more confident that inflation is going to stay at a lower level. That's what they've been looking for, and the big takeaway I have, guys, is that so many things were up only a tenth or down a tenth. It really is a broad decline in the rate of inflation, and that's what the Fed has been waiting for.
But not sufficiently confident, right, Mike? That's what we heard from Powell yesterday.
Yes, well, I think if you put him in a room quietly by himself, he might say he's sufficiently confident. But of course, the issue the Fed always has is how much do you lead the markets? Because as the wise man said, the Fed has a reaction function. The markets have an overreaction function. What I think you'll get now is no change in July, but a sentence that basically says if this continues, we're going to be able to start rate cuts, and everybody's going to take that to mean September, and then we'll get more hints as people speak along the way.
All right, Mike, thanks very much. Michael McKee there talking to us about the economic data, the data-dependent Fed, watching this number very closely. Again, inflation came down 0.1% month over month. So in terms of CPI, at least, that's pretty good news. Joining us now is Liz Young-Thomas, head of investment strategy at SoFi. And Liz, what does this data mean to you? I mean, is it a lock now for a rate cut in September?
Well, the Bloomberg warp function tells you that there's a 92% chance baked into the futures market now for a cut in September. I do think they will start to cut in September. There's been some narrative about whether or not they would do 50 to start off. I am not in that camp. I still think that they'll start with 25 so as not to scare anybody and do something much bigger than markets are expecting. Obviously, there's a lot of time between now and September, and we're going to hear from Powell at the next meeting. We're also going to hear from them at Jackson Hole. So a lot of things can change. We'll get 2 more CPI prints before that meeting even goes live. So the data is going to be interesting to watch over the next couple months. But here's what I would say about today's data. Obviously, that negative month-over-month print was a surprise for the market. A welcome surprise in some ways, because for a long time, we have been talking about needing prices to actually come down, not just stop growing as fast. So up until this point, we have had inflation still growing, just growing at a slower pace, and the absolute level of prices hasn't come down. So some of that takes pressure off of consumers, especially if we expect that trajectory to continue. However, what I think we're seeing right now in these choppy futures markets for equities is the question about whether or not this is too cool. So we've been cheering this cooler data for a long time, and now are we starting to worry, oh, wait a minute, it got too cool too fast? And I think that's what's going on in the futures market.
Well, Liz, not to risk making too much out of 30 minutes of movement, but does that help explain what we're seeing in the futures market right now? Because as I mentioned, you had futures on the S&P 500 spike and now come back down. We're currently just about unchanged. It's only the bond market that's held the move. Are we starting to see a little bit of that shift into worrying about growth?
I think it's undecided. I think investors are undecided at this point. Look, inflation is still running at 3% headline, and that's, or I'm sorry, 3.3%. That's not something that shows us that there's this concerning slowdown yet in the economy. But if we're worried about consumers pulling back too much, that would affect revenue for companies. This is one of those times where, okay, the Fed is going to cut rates. We've been clamoring for cuts. Is it actually a good thing, though? And I think that's what markets are really dealing with. Once they start cutting rates, here's an important point to think about. I know today was CPI day, but the labor market is also really important. Once they start cutting rates, they will likely be cutting into a cooling labor market, not a strengthening labor market. And equity markets are going to have to reconcile that with whether or not that means that prices should still be rising, especially at a time when prices are at these levels. We've got a PE ratio in the 86th percentile of historical periods for the S&P. So does a cooling labor market justify much higher prices in equities? And I think that's what investors are grappling with. Right now, it's tough to say that it does.
Liz, I want to also bring in some of the news that's just been breaking across the wire a few minutes ago here, that Envestnet has agreed to be acquired by Bain Capital and other private equity companies here at a price of $63.15 per share. Yesterday it closed at $61.70. I think also it draws a bigger question. What are the catalysts for this market? You are seeing, yes, earnings season hop into play. You're also seeing M&A in drips and drabs. How do you think about what this means for stock pickers moving forward?
So the catalysts for this market have been for a while, obviously the AI trade and this enthusiasm over technological innovation. I think that probably continues for a while. Obviously, we're starting a new earnings season very shortly, and we won't hear from those big tech companies for a while, but we start to set the tone with the big banks tomorrow. If earnings season continues to be healthy, if we see at least meeting expectations, somewhere between 8 and 9% growth for the quarter, I think that's part of the catalyst to at least keep markets afloat or even drive some further upside in those big names. The other thing that is working for investors and for momentum right now is that we've gotten accustomed to those big tech names being the defensive play as well. So when we're excited, those are the ones people buy. When we're worried, those are still the ones people rotate back into. So as of now, I don't know that there necessarily needs to be a huge catalyst to move it up. I think because people are starting to feel like maybe we're frothy in valuations, all we need is something that will keep it afloat. But again, come fall, and as this first cut gets nearer and nearer, it's the cuts that are more concerning. It's not always the hikes. So as that gets closer and as we hear from the Fed and what they're thinking, and if they adjust their economic projections in that September meeting, I think the market might have a little bit more difficulty trying to find that durable upside.
All right, Liz, great to get the take from SoFi. Thanks so much for joining us. Liz Young-Thomas there, Chief Investment Strategist over at SoFi. Let's get a quick look at the market, how stocks are moving ahead of the opening bell after a 37th record high so far this year. Yesterday, now we see futures moving back up. They had been down this morning. Okay, S&P futures unchanged, but the arrow is green. Jess Menton, who normally is always wearing green. I mean, what is going on today?
I know, I decided to switch it up.
Jess covers stocks for BN, and we count on you for direction here. It looks like this morning we were going to come down, and now I guess the inflation print has moved us up a little?
Right, so especially if you look at super core inflation, because Fed Chair Powell, as well as other Fed officials, look at that very closely. So if you look at the month-over-month numbers, that still is in a negative territory, actually, for the second time in a row for the second straight month. And actually, it's the lowest it's been since September of 2021. And the reason they look at super core is because it takes out the noise when you're looking at, say, housing, because we know about a third of the weighting in CPI is geared towards shelter. So when you look at that and get a better gauge of what wages look like, you're starting to see it move in the direction that the Federal Reserve wants to see.
It's interesting to talk about inflation today. Of course, we're getting earnings very tied to the consumer, right, and it doesn't look so pretty yet. What do we know out of Pepsi in particular?
And that's important because that's something that Tom Barkin from the Federal Reserve talks about as far as watching price to mix. And the reason he watches that is what it means for the direction of inflation. And that's something that companies like PepsiCo and other beverage companies and consumer packaged good companies like Conagra was another one that reported today. Both of those companies saw different issues there, particularly with PepsiCo. It missed when it came to those revenue outlooks that are happening there. And so what happened was it started talking about, it's interesting, their CEO talked about how they're going to start pushing through more promotions. And that's something that Jen Pertashis over at Bloomberg Intelligence has talked a lot about. So say if we're going to the grocery store and you want to buy something for 50% off or buy 2 for 1 and you get 1 for free, that's something that they've talked about that they're going to happen and that they're going to move forward with.
By the way, it's not really a beverage company anymore. I mean, the lion's share of their products, Pepsi, are food products, right?
Right. It's a good point. It's a good point. We're hitting the consumer from all sides this morning through the lens of earnings, of course. We're talking about a food and a beverage company. We're also talking about earnings. Let's talk about Delta, its outlook missing estimates. It talked about driving ticket prices down, and that, of course, ties into what we learned from CPI this morning. That's right. I mean, also, this is the first airliner that is going to report, and obviously, we're going to have United next week and others as
well. So if you're looking at that, it's actually capacity utilization that's been kind of an issue with trying to compete with the demand. If you're looking at the year-over-year periods, you're still seeing strong travel demand. And then you're also seeing, when it comes to the business side of that, picking up as well. But it's the capacity issue. And their CEO was talking about how it's about an issue of about 3 to 4% higher right now. And so they're trying to make some sort of regards as far as once they get to September, how to sort of mitigate some of those types of problems. But that's what you're seeing in the airline space. So if you're looking at Delta right now, at that stock, DLA is the ticker symbol, down almost 9% in pre-market trading. So you're starting to see that way on other, right? If you're looking at over at United, that's down 4.6% ahead of the opening.
Yeah, all the airlines, I noticed American is off, Southwest is off. So maybe in sympathy. Jess, thanks very much for joining us. Jess Menton from Bloomberg News. She covers stocks for us. We're talking about the consumer. We're talking about earnings. And we should talk about where else the consumer is belt tightening. Electric vehicles is one that we've been watching very closely all year, and it's a capital intensive business as well. Lucid wants to compete with the biggest players. Earlier today, Lucid CEO Peter Rawlinson spoke to Bloomberg about the future of his company.
We are in discussions with others, and when it gets really exciting is you look at the technology that we're developing now for a mid-sized platform for late 26. That really suits mass market family car applications. That's why we're in this. Yeah. We're not here to be a niche player.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
All right, let's get to high interest now. Look at what's making headlines around the world. President Biden's re-election bid facing mounting opposition within his own party. Nancy Pelosi said Biden should quickly consider whether or not to stay in the race, even though he already said he's definitely going to. Vermont's Peter Welch became the first Democratic senator to call on the president to withdraw. Axios reporting that Senate Majority Leader Chuck Schumer is also open to replacing Biden on the ticket. And even Hollywood heavy hitters like George Clooney are pressing for change, which is key, not because he's a famous actor, but because he's a big donor and fundraiser. Manhattan's apartment market reaching new levels of competitiveness last month. A record high 24% of leases were signed after bidding wars. That's according to data from Douglas Elliman Real Estate and Miller Samuel. Units were listed for an average of just 24 days before getting scooped up, and rents held fairly steady, but the peak months for demand are yet to come. Tesla shares are climbing at a frenetic pace, but it's becoming harder to argue the case for the bulls. The last time there was a run like this, the rally was supported by revenues expanding at a double-digit clip. Things seem a lot gloomier, though now the mood around electric cars is subdued. Tesla's sales are shrinking while profits sag.
Yeah, it's a really fascinating juncture, I would say, for Tesla, because EV demand, you're seeing it being an issue for a lot of automakers. But unlike some of those more traditional players, Tesla is pure play EV. They're not going to pivot into hybrids, for example.
And it's interesting because you've had them on an 11-day run. Today is another make or break moment for them. They are trading at pretty sky-high levels here, about 90 times forward earnings from what I understand. And this is one of the longest winning streaks it's ever had. 13, Katie would make a record.
The market cap is $840 billion. So I think it's always pretty difficult for bulls to make the case at that level, right?
Yeah, but shorts have gotten super squeezed.
Oh, big time. I will note that it's back to being up 6% for the year. I mean, this was one of the big, heavy draggers in the Magnificent Seven. Now that story is flipped around.
I know the stock is down about 35–40% from the peak in 2021. That's because I read Ed Ludlow's story on Rivian. Let's talk to the man himself right now, because Rivian is trying to convince Elon-phobic car buyers to drop $70,000 or more on its trucks. Now the challenge is to turn a profit. Bloomberg Business Week dives deep into the startup's plan to do that. A new mass market EV, a tie-up with VW, and a battle to find funds as it burns through cash is the story co-written by Bloomberg Technology co-host Ed Ludlow. Ed, it's a fantastic piece, and of course you've been covering Rivian very closely for years now.
Yeah, I mean, it's of lots of interest for lots of reasons, right? Americans love SUVs and pickups. Rivian came out of nowhere to bring the first battery electric 3-row SUV and pickup to market. They're backed by Amazon, they're backed by T. Rowe Price, like everything you'd want for like Bloomberg Terminal Reader catnip or EV enthusiast catnip. And as we explain in the story, they got off to this amazing start. Loads of these like kind of hardcore Tesla fanboys defected to Rivian because they were fed up with Elon Musk, or they wanted this big EV. They didn't want like little boxy Model 3 or a little Model Y. The problem is then it kind of stops there, and they burn through billions of dollars of cash. So we wanted to just do like the definitive, this is what Rivian's new plan is, and this is how it's going to get itself out of a financial hole.
Well, tell us more about that VW partnership that, of course, made waves a couple of weeks ago. How does that fit into this story? Because a lot of people build that as a lifeline for Rivian.
Yeah, there's a lot of like frenemy status going on in that industry right now. The CEO of Volkswagen was an admirer of Rivian, an admirer of RJ Scaringe. Last summer, RJ met with Oliver Blume, the CEO of Volkswagen, in Atlanta at Porsche's kind of excellence and design center. And when he pulls up into the parking lot, he's like, hey, there are some Rivians in this parking lot. Like, what's going on with that? And all car companies benchmark against others. But, you know, over time they talked. Rivian desperately needs the money, so they get $5 billion over 3 years. But what we report is, A, this is not an exclusive deal. You know, Rivian can talk with other people on technology partnerships, but their plan is to go together with a JV and sell the technology to other automakers. So it's an interesting hedge for VW, and for Rivian, it's like a pretty cushy deal.
A cushy deal, but at the end of the day, Ed, do you expect really traditional car makers to save Rivian at the end of the day and really push their own story forward when really they were seen as such an innovative upstart at the beginning?
Right. Yeah, I think that what we've learned is that Rivian is actually very competent. It's very good at software. It has proprietary design of the key control units within its EVs. Its batteries are great, but it's just not very good at kind of getting there. You know, you guys spoke to Peter Rawlinson of Lucid earlier, and the famous soundbite from his, "We are not a niche player." I think producer Joe Choffey has a fantastic chart that just tells the story. Lucid is very much a niche player. Rivian is still kind of a niche player. It's had so much trouble scaling, and the market incumbent, all the while Tesla, as told by that chart, has just kind of run away with it for battery electric cars. So the question that the BW story poses, and the explanation, is how Rivian jumps from that little sliver in the middle of the screen to catching up with Tesla. The VW cash is a big part of that. And the investor belief in them as well.
Mm-hmm. Ed Ludlow, it is a great piece. Really appreciate you taking some time to talk to us about it. That is Bloomberg Technology co-host Ed Ludlow. Matt Miller, I know you have something to say.
Yeah, because, you know, I have a podcast called Hot Pursuit, which you should definitely check out. The Rivian is an amazing vehicle. I mean, beyond the design, which I love, but obviously that's subjective. The tri-motor version has 850 horsepower. The quad motor over 1,000 horsepower. I mean, even though you don't get the excitement that you do from an internal combustion engine, the sound, the vibes, the smell, it's so fast.
The emotion of the engine, it's just not there.
You're right, but maybe the emotion of that kind of speed is a winner.
You know what has a lot of emotion? That is earnings season. And coming up, from Doritos to Duncan Hines, a fresh round of earnings are shining a light on a struggling consumer. Details next. This is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep winning World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond. All right, it's time now for Social Climbers, the companies making waves on social media this morning. And first up, nothing is certain in life but death and taxes and maybe AI. TurboTax parent Intuit slashing nearly 2,000 jobs as it pivots to AI-powered tax prep software. The company will close 2 of its sites in Edmonton, Canada and Idaho. Next up, we have Apple dodging a bullet, the tech giant avoiding fines from EU regulators after it agreed to open up its mobile wallet technology to other providers free of charge for a decade. Now, under the settlement, European consumers can use alternative digital wallets to pay for goods and services at checkouts. And finally, you're going to have to pay more if you want to shop at Costco. The membership-based warehouse club increasing its membership fee by $5 beginning in September, which is the first increase in 7 years. The charge will impact about 52 million memberships, but the one thing that stays the same is that $1.50 hot dog combo. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal, Matt.
All right, let's get a quick check on futures. Will we see a turnaround in equities today? We had futures down at the start of the program 26 minutes ago. Now you can see S&P futures unchanged, up 1/100% as inflation data came out better than expected. Coming up, Max Kettner will talk about it to us from HSBC. This is Bloomberg.
you feel like this age of abundance over the last few years of just how much was being made?
For my personal taste, I am thrilled at what I get to find every night if I have time to look for something. So I personally don't think too much was made. I think the customer will tell us when there's too much made and they won't watch things. And I think part of the misalignment I talked about before is imagine if things didn't get picked up or movies didn't get made that people didn't watch or go to see. That's how it used to be. The customer decided. I do think there's going to be less made in the middle price range. I think there's going to be more made in the higher price range because when you get to global events like Barbie or Oppenheimer or Super Mario Brothers, it's worth the investment, and it's clear that the audience is there, and they just need to be given what they want. The middle, which ends up, quickly on one of the services in a way that we're watching movies that we don't know how they got made or when they got made and all of that. I think that will probably be curated better, and I hope there's more inexpensive things that give more people the chance to express themselves and have their work seen.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Moments away from the start of trading, and we have futures bouncing back and forth. Could we have a 38th record high today? It's possible after that CPI print. In terms of the opening bell, Oliver Wyman ringing the bell right now. They put out a research report on CEOs dealing with this macroeconomic environment. In terms of today's earnings reports, it doesn't look like they're doing such a great job. A lot of misses, especially for consumer companies, and that is why we had futures down. But Katie Greifeld, the CPI print was better than expected. Is it driving the market up at the open?
Not necessarily, maybe at the margins. You take a look at where we stand just seconds into the trading day, the S&P 500. I'm going to go ahead and call that unchanged. Of course, we did shoot higher pre-market after we got those CPI numbers. Not so much right now. You take a look at the Dow Jones from that. It's also pretty much unchanged, maybe 0.1% higher if you're an optimist. And big tech actually taking a breather here, falling a little bit at the opening bell. But let's get stock specific here because we have to talk about Pfizer, really higher after the drug maker announced progress on a weight loss pill. That could be a needle-free competitor to the likes of Novo Nordisk and Eli Lilly. You can see Pfizer shares currently up about 1.8%, Shanali.
Also keeping an eye on earnings here, of course. This one's kind of related to Pfizer, though, however. Pepsi now posting a weaker than expected revenue growth this morning. Shoppers becoming more focused on their budgets and health, of course. ConAgra also lowering after issuing disappointing forecasts. Both stocks now down 2.6% on ConAgra and PepsiCo at 3.4% at the open.
All right, so some consumer stocks getting hit. Delta Airlines also dragging down travel stocks after their forecast missed Wall Street expectations. Let's take a closer look with Bloomberg's Abigail Doolittle. Abby?
Well, we have some real weakness for these airlines here, and Delta Airlines putting up a disappointing quarter, especially relative to profits. Profits down 29% on a year-over-year basis, missing the mark at $2.36 for adjusted earnings per share. This has to do with a glut of seats and the rising cost of fuel, less so relative to demand. And you can see all of these stocks are down, having to do with this weakness, the all-important summer travel season. But it's not really a demand issue, interestingly enough. There's just too many planes, so they are working to get capacity out of the air. If we take a look at the S&P 500 relative to the airline index over the last couple of months, today's announcement and the drop, not so surprising to everybody. You can see the S&P 500 in orange here, up about 8% over the last 2 months. But take a look at the airline index, down more than 10% now, down 16.5%. So again, not everybody is surprised by this. I guess we have to see if these airlines can rein in that big supply.
All right, Abigail Doodle, thank you so much for that roundup. And joining us now for a broader look at markets, we have Max Kettner. He is HSBC Chief Multi-Asset Strategist. And Max, I'm looking through your notes, and you write that we have started a new everything rallies equity cycle. And that sounds very exciting, but I want you to explain it a little bit. Does that mean we're going to broaden out from tech, or what exactly do you mean?
Yeah, I think, look, when we look, for example, today at the CPI report, that's a pretty much an everything or buy everything environment where you can buy, you can buy sovereigns, you can buy credit, you can buy high yield, you can buy emerging market debt, you can buy equities. It's really an environment where growth is not too hot, not too cold, where inflation is no longer seen as that much of a problem as it was perhaps September, October last year, or that little bit of a scare that we got in April. So that really is that kind of backdrop where you're really saying, hey, look, just be broadly bullish across all the asset classes. You know, we're up, Max. On the S&P, we're up 18% year to date. We've had 37 record highs in a row, which I'm sure everyone's sick of hearing about, but it's just an amazing number because it's the second most this century after 2021. The S&P is up also 57% since the bottom in 2022. At what point do you start taking profits off the table and saying, like, you know what, earnings can't justify this going forward? So, Matt, there's two things. Number one, if sentiment and positioning really becomes way too stretched, that, I think, is one of the points where we'd be really a bit more cautious. I don't think we're at that point quite yet, because when we look at, for example, our sentiment and positioning indicators, yes, real money investor sentiment has become more bullish, fine. But when we look at our shorter term positioning indicators, things like discretionary and systematic positioning, that is still broadly neutral. It's not even sending even a tiny mild sell signal right now. We're not even at that stage yet. So I don't think really this is the time to pull the plug quite yet. But with regard to earnings, what you mentioned, yes, earnings expectations are definitely a little bit higher. I'm not quite concerned now. I think where I'm starting to get more concerned is from the fourth quarter onwards, when we start to see really the expectations for the broader market taking up hugely. By the end of this year, by the fourth quarter, consensus is saying that ex-Magnificent Seven earnings growth will pick up to 18% year over year. That seems very, very challenging. It's not something that we can play right now. It's not something we can position for right now. It's probably more for the end of the year, if not even the start of 2025.
You know, it's interesting, Max, you're taking a look at Fed futures swaps, frankly, after that CPI data this morning, and you're seeing a roughly 90% chance of a September rate cut being baked in here. That's still a number of months away, and it's still just one rate cut. And so if you think about the forward look here and any concerns about that impact of higher interest rates, higher for longer, any growth concerns, how do you play that concern into the market that you're frankly so bullish in?
Yeah, look, I guess that is really one concern as well, that the market perhaps is going to make the mistake into that first September rate cut, which we are forecasting as well, and really then trying to forecast or trying to bake in a traditional rate cut cycle. I think back to Matt's point, what makes us more concerned, that is something that makes me concerned as well. So I can see sentiment and positioning becoming much more stretched, much more bullish by sort of September. The market then really trying to sort of brush off the old traditional playbook saying, hey, you know, once we got the first rate cut, obviously that's going to be a traditional rate cutting cycle. That ought to be good for everything. And that's then the time where perhaps you want to sell that first cut.
So what's left out in the cold? Because you think about the traditional rate cutting playbook, and you see, for example, bonds rally. You also see small caps rally, but it's something that I keep coming back to because the small cap trade just hasn't worked, and a lot of people have told us to just be patient. Rate cuts will come. They tend to lag that, but then you'll see some of those smaller companies start to benefit. But what's your view over at HSBC about what actually happens to those smaller tiers?
Yeah, so on US small caps, I would continue to be pretty cautious. We've been cautious throughout, really, because the problem with US small caps is, of course, there's a huge degree of companies, a huge amount of companies, almost 40% of them, that are not making profits, that are sitting on negative earnings. There's a huge chunk of those companies as well that are really financed on a floating rate. So both of those things, if we were to get a sudden drop in activity or if yields were to suddenly pick up again, both of those tails would not be good for US small caps. So on that, I still caution. I think when we talk about the small cap trade, I'm more excited about European small caps. Look at the UK GDP number today. It doesn't look that awful. So I think a lot of the leading indicators, a lot of that drop that we had now in June really was perhaps a little bit too much sentiment driven. And, going forward, I think both Eurozone and also UK small caps actually make sense because, yes, growth in the Eurozone on an absolute basis is hardly inspiring. But when we look at how much and to what degree expectations have been revised lower over the last 9 months, it only needs a tiny bit of an upside surprise. And that could really get people already excited about European small caps again. Hey, Max, this is an equities show right at the U.S. Open. We always obviously cover equities, but you're a multi-asset strategist. You get paid at HSBC for your big picture look. You're overweight high yield credit. What does that mean about your view of the U.S. economy? That things are broadly still fine. They might not be accelerating, but that's not what we need. When we look at the last 4 years, in fact, when we look at the US economy, it has gone already through 2 distinct default cycles in the last 4 years. So a lot of the weaker parts of the credit spectrum have been wiped out. So in fact, when we look at US high yield, it looks a lot better. When we look, for example, at the share of triple Cs, so the weakest rated companies, that's a lot smaller compared to 10 or 15 years ago. That's actually both the case in Euro high yield and US high yield. So it tells us that broadly, things are still okay. They might not re-accelerate, but they don't have to. As long as really growth is just chugging along, that is great for carry strategies such as a long high yield position.
Max Kettner of HSBC, we thank you so much for being with us, of course, on our launch week here at Open Interest. Now, coming up, it's my happy place. Big bank earnings kick off tomorrow. We're going to speak to Erica Najarian, UBS equity research analyst, large cap banks, and consumer finance, certainly a hot area of the market right now. That's up next. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
This is Bloomberg Open Interest. Let's get a quick check on what's going on in markets right now. We do still have red arrows on the S&P 500 and the NASDAQ. So we haven't had a turnaround in the cash trade even after the 8:30 a.m. CPI print came in showing a decline, a contraction month over month, which should be good news in terms of the Fed, in terms of the economy, and indicate that we get a cut sooner than later. Nonetheless, we had a 37th record high yesterday, so maybe investors are selling that news, Katie.
All right, let's get to some of our top calls. The analyst action in focus this morning. And first up, Jefferies cuts Olive Garden owner Darden Restaurants to underperform. The firm said that the chain could lose share if it needs to add more promotions in order to lure those cash-strapped diners. Even still, stock is unchanged. Next up, we have Morgan Stanley cutting On Semiconductor to underweight. The analyst says that the chipmaker faces a number of headwinds across its automotive division. Stock a little bit lower just moments into the trading day. And finally, we do have Raymond James initiating coverage of Citizens Financial with a market perform rating. The bank's management setting expectations for weaker net interest income at an investor conference recently. And of course, that bank reports next week, Shonali.
And we're going to stick on banks. JP Morgan, Citigroup, Wells Fargo kick off earnings season for the banks tomorrow. For, of course, the second half of the year, followed by Goldman Sachs, Bank of America, and Morgan Stanley next week. Joining us now with a preview is Erica Najarian, UBS equity research analyst for large cap banks and consumer finance. And let's start with what we have today, because with such a drastic move lower in 2-year yields and 10-year yields, you do see the money center banks being the biggest decliners here in the KBW Bank Index, Citigroup, JP Morgan, Bank of America, Wells, all down on the day. What is the ultimate impact of such a sharp move lower?
So keep in mind that the money centers were huge outperformers so far this year, massively outperforming the mid-cap bank index or the carry. And so I think the setup today is, oh gosh, September is live. Not only is it live, there's an 88% chance that we're going to get our first cut sooner rather than later. And so this is a bit of a reversal of the trade. Everybody was hiding in the money center banks in terms of higher for longer. And now, given especially the valuation, and if you pair that with, the coming elections, I think you're really starting to see that trade reverse and regional banks get a bid.
It's interesting because you do see already that expectation starting to moderate for net interest income. If you see a move this much lower in rates, does it mean people want to borrow more, or does it mean that there's just more pressure yet again?
Yeah, so let me set up sort of the Goldilocks scenario that I think the market is hoping for in terms of what happens after the Fed cuts rates. So the Fed cuts rates, and then regional banks will get relief in deposit costs. There's going to be some relief in terms of commercial real estate refinancing, at least a perception of relief. And then it's going to be enough to reinvigorate loan growth. I don't know if all of this will happen, but I think that's the initial knee-jerk reaction to the CPI print.
Erica, the other thing that happens after the Fed cut rate, if they do it in September, is we get either a Trump presidency or a centrist Democrat. What difference does that make to these big banks? Because if you watch, for example, Powell's testimony, the Democrats are grilling him on being, they allege, a representative of the big banks, and that's a bad thing from their perspective.
Here's the thing, though. We got two headlines essentially this week that even under this administration, we're seeing some relief in some of the regulatory constructs. So this whole Basel III endgame rule that would be really, really tough on capital for the banks. Chair Powell said he'll repropose that. And there's nothing more effective for banks than time. Second, they're also dealing with changing how to calculate the GSIB surcharge, which is huge, right? Because that could lower the capital requirement for big banks. That being said, if we do have a Trump presidency, that reaction is going to be, gosh, we need to buy the smaller banks because there's going to be potentially, a logjam breaking in terms of consolidation.
And so we're talking to you on the eve of earnings season for these big banks, which is a lot of specific catalysts there. But we have a question from a client saying, shouldn't a rate cut be good for bank portfolios? And that kind of bleeds into a question I wanted to ask, which is, what do the bank equities actually trade on? Because it feels like, again, we're in earnings season, we get some specific news, maybe they trade on that for a day, but then it just feels like this entire sector goes back to being a macro story.
It always is going to be a macro story. I think that while we can debate on the impact of the first cut, how many cuts, I think at the end of the day, you know, how to get more breadth in terms of portfolio managers owning more banks than just JP Morgan, BofA, and Wells is proving to the market that the risk reward isn't like the reward is underperforming the S&P and the risk is zero. And, you know, that's what you've seen over the past 15 years. You've seen, obviously, the global financial crisis and then last year's regional bank crisis. So it almost feels like for banks to truly pop off, to use a Gen Z term, they really need to go through a real recession and proving that it's an earnings issue, not a capital issue.
Erica, there are some of your rivals here on Wall Street that believe that it is a market for Wall Street, that Wall Street banks might do better than the traditional Main Street banks in this environment because of this rebound in capital markets and investment banking. There's skepticism around that too. How much do you believe that that could really fuel profits going into the end of the year?
So I think there's definitely, I mean, the comps are super easy, right? The activity levels last year were super weak. And so you could definitely see activity levels in banking and equity capital markets, debt capital markets especially, continue to be strong. But I also feel like, you know, the election is such a pivot point. And so you could see, whether it's in loan demand or M&A activity, some sort of near-term pausing, and then once there's certainty, whoever wins, then you could really see 25 activity levels soar from here.
All right, Erica, thank you so much for coming in. Erica Najarian there of UBS, right ahead of the big day for banks earnings. I know it's like your Super Bowl, right? So what time do you wake up on bank earnings day?
Like 3:30. I can't wait. It's like opening presents in the morning.
All right, it will be exciting for sure. Coming up, more financial news, more Wall Street beat for Shinalia. Guilty verdict for Archegos Capital Management CEO Bill Wang. That and more. This is Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
All right, this is Bloomberg Open Interest. Let's take a look at the markets right now in the wake of that CPI print. You can see the S&P 500 pretty much flat, maybe 0.1% higher, even though you had this big rally in the bond market. 10-year yields down 9 basis points, almost 10 basis points on the day. Big rally there, not matching the S&P 500, but where you are seeing action is in the small cap index. That Russell 2000 screaming higher, up 2%. So the S&P 500 couldn't hold its bid, but small caps and bonds is where all the action is at this morning, Sonali.
And Katie, it's time now for the Wall Street Beat, the most talked about stories in finance. And first up, we have to talk about none other than Bill Hwang, found guilty of criminal charges stemming from Archegos' 2021 collapse. And remember, it's him as well as his co-defendant, the former chief financial officer of Archegos. This was a heated trial. Paul Davies of Bloomberg Opinion asked a good question. Could Archegos happen again?
It's a great question, really. And I mean, I think that's everyone's worst nightmare, right? That when you think about the black swans that are still out there, do we have something like that hiding in plain sight? Is there another $36 billion family office that is just being a little bit too risky?
Yeah, I guess it was interesting to see. I mean, the testimony was amazing, right? And to see the relationships between these traders and their prime brokerage, they were so chummy that there was just too much trust, and that's what made it happen.
And some things in the market have changed. Of course, Credit Suisse is no longer really in this market, but some things really haven't changed. They tried to really change up swaps rules. They tried to change up family office rules. None of that happened at the end of the day. So
yeah.
Time, I guess, will tell.
And there's some great details, a lot of TikTok that has been in the reporting around this case. I thought this was interesting from the jury. We were talking yesterday about how the judge was saying that both sides were boring the jury, but one of the jurors who asked to remain unnamed, he said that he was on the fence during most of the trial because he worked on Wall Street for more than 3 decades. But he said that Hwang, in the end, condemned himself because he was trading on such a large scale and had that manipulative impact on stocks.
Can I just shout out to Chris Dolmetsch?
Yes,
the Bloomberg reporter who covered this did an amazing job. I mean, following what he was doing in the T-Live, and he was covering other trials as well.
He was.
So working around the clock, Chris Dolmetsch, you have to write a book about this trial.
Ava Benny Morrison and Sridhar Natarajan and Miss Rolena Golpapoulou, just a total all-star cast. But next up, inside Ken Griffin's Citadel Securities, a strategy for handing even more of Wall Street's trading over to the market maker. That strategy is starting to take shape. It's a nascent strategy, which would have firms deal with clients here. Citadel Security would be dealing with banking clients, while Citadel Securities handles the behind-the-scenes mechanics. It's fascinating, guys, because this is a year in which they're already on track to hit half-year profits, according to Bloomberg's reporting. And remember, this is an extension of what we've seen bank trading desks weakening under capital rules. It ties into the broader story, and Ken Griffin really coming out on top here.
Yeah, really timely story. I mean, just to oversimplify it, it sounds like this is basically white label trading that they're doing, right?
It is, and it's interesting. It reminds me a lot of what other firms like Jefferies and Co. have been doing, because they have been outsourcing trading to other investment banks, while the biggest of banks have more and more constraints, and instead turning to things like prime brokerage, lending to hedge fund clients, instead using those balance sheets when it works.
But it is just another story of these big banks losing business to upstart competitors, right?
You know, this is not quite the same, but you think about just these like synthetic risk transfers that are happening, hedge funds that are taking on loan books from banks, and that's exactly another extension of just banks offloading to the non-banks in a bigger and bigger way.
All right, that was Wall Street Beat. There's always so much to talk about, and we could do like an hour. Someday we'll do an hour show on the Wall Street Beat. Right now, let's get the trading diary, what you need to be watching this week. We'll get more Fed speak from Raphael Bostic today at 11:15 a.m. Then at 6:30 tonight, President Biden holds a news conference at the NATO summit. As it wraps up there, that will be unscripted, and it will not be pre-taped. It will be live, so people are paying very close attention. Also paying close attention to JP Morgan tomorrow, plus Wells Fargo and Citi. Those 3 banks kick off Sonali's Super Bowl, big bank earnings on Friday, and we'll get the University of Michigan consumer data, so more data for the Fed. Coming up, we're going to talk to Steve Eisman from The Big Short, senior portfolio manager at Neuberger Berman.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or what? How do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube as well. Alex Steele and Paul Sweeney here. It has been a CPI data been a little bit later than expected, so we're going to break that down with our guests, leading off this morning with Emily Rowland, Co-Chief Investment Strategist at John Hancock. Then Gina Martin-Adams from Bloomberg Intelligence. She's our equity strategist. Get her thoughts. Sri Natarajan, Bloomberg News Senior Finance Report. You got an interesting story out here. Citadel Securities, Mr. Griffin, crafts plan to shake up banks' trading desk. That got my attention. We'll break that down coming up in this hour. So we got a lot coming up in this hour. First, let's go to John Tucker and get a Bloomberg Business Flash, John.
All right, and Paul and Alice, let me start with yields, because that's where the real action is. The more policy-reactive two-year yield Treasury down 11 basis points. We're at 450. The 10-year yield 10 basis points. We'll call it 11 basis points lower. Right now at 417. This comes after the inflation data we got. Inflation moderating for the month of June. Another dose of confidence for the Federal Reserve to cut core consumer prices, registering the smallest increase in about 3 years. So that reflects slowdown, a long-awaited slowdown in the shelter costs there. And as a result, equities right now, not a lot of movement. We're still around the records for the S&P 500, 5 points higher, up 0.1%, 5638 on the index. NASDAQ Composite Index, 9 points lower. That's been in and out of gains and losses. And right now, the Dow is up 73 points. Pfizer shares among the movers this morning. Those shares up 1.4%. Drug maker says it's advancing the development of its once-daily weight loss pill. And Nora Melinda is going to be along in a moment to actually pronounce the name of this drug, because I can't.
She thinks that's optimistic of you, I think, from her facial expressions right now.
I don't know where they come up with these names.
I totally agree with you. I have the same thought all the time.
But anyway, Delta shares, they were down 8%. They expect profit this quarter to fall short of Wall Street expectations. So earnings season is underway. And, of course, the financial institutions, they start reporting tomorrow. So that's going to be fun. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and we are being brought to you by IBKR Financial Advisors. They switched to interactive brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest at ibkr.com/RIA. Alex and Paul.
Thank you so much, John Tucker. Happy Thursday, everybody. Happy Friday to Paul.
Coming up.
Coming up, yeah. He has his
now, the
summer
problem
Fridays.
is getting home today. Apparently, New Jersey Transit is not running down to the shore, so it's going to be ferry. Plan B, we're going to take the ferry.
Okay, wait. Weird. New Jersey Transit has problems?
Oh, they do. There's something to do with a bridge, John alerted
brand
us to.
new
This
information.
is the train bridge that crosses over the Raritan River, adjacent to the Driscoll Bridge on the New Jersey, the Parkway, the Garden State Parkway. So that's messed up. A little problem.
It's okay.
I don't
We have
know.
Plan B.
And this is one day that New Jersey Transit cannot blame Amtrak, because
That's right.
that is not an Amtrak section.
Well, you know, you have at least 24 hours to get there, so that's fine.
Yes,
I think you'll be okay.
I'm good.
Okay, let's get to the market, because I find the market reaction super interesting. The S&P, yes, that record high, but also individually, there are some stocks getting seriously pummeled on the downside, like Delta, for example. We'll get to that in a second, whereas the bond market and the currency market seems very much related to that slower than expected CPI rise. So let's get Norma Linda joining us here. I mean, he teased it for us, so I feel like we need to start with it, and that's Pfizer and the weight loss drug pill and the name that no one wants to pronounce.
Right, and we're not going to have me out here pronouncing it wrong. But we're watching Pfizer because shares are surging as much as 3.1%. This is the most intraday since May. The drug maker essentially said that it's advancing the development of its once daily weight loss drug. I'll try it. Daniel, let's not do it. Let's not do it. But
That was pretty awesome. Okay.
It says that it plans to conduct dose optimization studies in the second half of this year. It's evaluating multiple doses of this preferred modified release formulation to inform registration studies that it has going on right now. And of course, we know it's really jumping into a very, very popular market right now. So we do have investors rallying behind the stock. Truist actually points out that they view this as a positive for the company, especially as they're entering a very lucrative space. We know everyone is interested in weight loss as we're here in the summer.
The Nuglupron.
That's your take?
The Nuglupron. I'm going
You
there.
just go with it. Yeah,
I'm
yeah,
going
yeah. I
there.
mean,
We
if
should
you
all
say it
take
with
a guess.
authority.
Yes.
Apparently
You
just
say it with
rolls
authority.
off
I
the
feel like
tongue.
Stay
it's
with
fine.
authority at work.
The people at Pfizer are cringing.
Yeah.
Right, they hate to hear this.
I really do wonder, like, who comes up with all the names. Like, there's got to be some kind of science.
What's the origin
for that.
story?
Scientists. If they're not. It's not a marketing person. It's got to be a scientist.
It has to be.
It should be a marketing
It
person.
should be a marketing
no?
person. Like,
You
weight
would
be
think.
gone. Weight be gone.
Weight be gone.
Weight be gone. I like that one.
Paul, third career.
Let's just
There you
change
go.
the name.
All right, so that's one part that we're looking at. That we've been waiting for that pill. Like that's going to be key. But you're also looking at airlines. I mentioned sort of what's dragging on the S&P. I mean, Delta's results not good.
Not good at all. I mean, people are really looking at the outlook that missed expectations. Its third quarter adjusted EPS fell short of what expectations were for the company. Its adjusted earnings will be between $1.70 to $2 a share, it said in a statement, which is short of what analysts were expecting here. And an interesting story that my colleague Peyton Forte actually pushed out was just talking about how Wall Street is betting against airlines even as we're in what people expect to be a summer travel boom. And short interest in the $1.1 billion ETF that tracks a lot of these airline companies actually accounts for over 27% of that ETF's free float after touching 30% earlier this month. So looks like Wall Street's not really having the best expectations for this.
George Ferguson from Bloomberg Intelligence, I hate to give him too much credit, but he was right on this. He was very conservative on these airlines. I'm like, why? Every plane I go on is packed. How can you not make money now? But he was saying that, the fares, despite the demand, the fares are not nearly as strong as people would like to see. Plus, the costs are higher, so the margins are pinched. I don't know. He was right, I guess. I don't know.
Also, in the CPI, to draw it into the eco data, airline fares fell 5% in June. They fell 3.6% in May. I haven't seen it personally, but apparently that's what they say.
Well, Tom, on a daily basis, will price out Newark to Paris. Because, that's where he plays, in Paris. And he says it's half of what it was back in the day.
Really? But international has been holding up. Like, the real pressure has been domestic. He should do, like, New York to Idaho. No,
Tom's not doing
it's
it.
not New York to
It's
LA.
Paris. It's Paris.
All right, fair enough.
Well, I also wanted to dig a bit deeper into the CPI data. I'm looking at housing-related stocks.
Of course.
I mean, who could ever guess?
Right.
Looking at these housing stocks, they're actually surging. We're seeing real estate as the best performing group in the S&P 500 this morning. And this is coming after the CPI data report showed that shelter costs have shown the smallest monthly increase since August of 2021. We're seeing owners equivalent rent up just 0.3%, which is the lowest since the fall of 2021. Rent for shelter up 0.2%, and rent for primary residence up marginally. And one thing that's interesting to note is that lodging away from home actually fell by 2%, which is interesting, especially as you're thinking about this being the time of year where you would expect a lot of tourists to be out in places, and you would think that things are really, bustling and full. But lodging did come in as a surprise, falling by 2% when we're looking at inflation there.
So that just goes to the point that if you fly an airline to Idaho and rent a place there or a hotel there, you're good. That's where the disinflation is going to be. Hey, Nora, we really appreciate it. Thanks for playing with us. Norma Linda of Bloomberg joining us there. All right, let's get a broader take on the market here. Emily Rowland, one of my favorites, co-chief investment strategist for John Hancock Investment Management, joins us now. Emily, the reaction is clear, right? The S&P responding more to earnings, then you have the bond market and the currency market responding to that CPI data. What's your take over the last couple hours?
Oh, so much relief right now, especially seeing that shelter component coming in at 0.2% month over month. It just felt like it was Groundhog Day. Every time we've gotten CPI reports this year, it's just been that sticky shelter component. And I think there's a lot of relief that that's coming down. I think the challenge that the market's contending with right now is when does kind of good news on disinflation maybe put pressure on growth and corporate earnings? So the way that we've been thinking about it is, yes, disinflation traction is great for consumers. It means the Fed can start cutting, and I think we've solidified a September cut after today's report, but it's not necessarily the best thing for corporate revenues. In fact, we're finding that a lot of companies are now having a harder time passing those prices along to the end consumer. If you look at the guts of the CPI report today, it's stuff people want. Right? Like, Alex, clearly you want to go to Idaho, but it's things like airfares, it's things like cars, used cars, new cars, it's things like, other sort of discretionary items that are falling because companies have less pricing power. That means revenue growth might slow. At the same time, the cost of capital is still elevated for companies, so their margins are going to come under pressure here. And I think that's the reason you're not necessarily seeing that massive pivot party that we've seen with other CPI releases coming down, because it's not the best thing for corporate earnings from here.
Well, I'm a former equity analyst, but I know all along that the fixed income folks are much smarter. The bond market's definitely reacting to what's happening out there. We got the 2-year, as John Tucker likes to call it, the most interest rate sensitive and Fed sensitive instrument out there. The 2-year Treasury, it's off almost 12 basis points, 4.5%, and we were at 5.02% on April 30th. So big moves in the bond market. What's that telling us, Emily?
Yeah, so we've been suggesting that investors lean into high quality bonds over the course of this year, even though the path has been bumpy. I mean, it's amazing. We started at 3.88 on the 10-year Treasury yield this year. We're still not even there yet, back down to that level. So it's like the bond market hasn't really sniffed out this disinflation trend yet. So we were suggesting that investors take advantage of that big backup in yields that we've seen to lock in those higher interest rates. When the Fed does start cutting, when rates start to move lower, it can happen really quickly. So many of the investors that I've been talking to this year, we're just going to wait for the Fed to cut in order to leg into duration a little bit more. The challenge with that is that you're going to miss out on a lot of the total return potential in bonds if you wait for the Fed to cut. We know that the 10-year Treasury yield, or really the entire yield curve, is going to sort of suss that out before the Fed actually starts cutting. So that's why we think it's important to get paid income here while we can at these elevated levels, close to 20-year highs on bond yields. Pretty awesome.
So then if we just go from the 10 for a second. So steepener trade seems to be in play today, but that's more because the front end and the stronger buying in the front end. How do you want to be playing that?
Yeah, I mean, we are suggesting essentially looking at the intermediate part of the curve right now for the best opportunities. Looking at 7 to 10 years of maturity. And again, locking that in. Right now, the trends that we're seeing is that it's cash, 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 CDs. There's $6 trillion, Alex, sitting in money market funds right now. That is unbelievable. And so what we're seeing is investors are loving getting paid this close to 5% risk-free rate. But our contention is, hey, by the way, that's fine. It's great that there's something else to do with short-term cash, but it's really a terrible long-term investment. So just going out the curve, embracing the intermediate part of the curve, locking in that 5, even 6% income for many, many years, we think we're going to look back and really identify the fact this was a great opportunity to take advantage of these higher yields before inflation comes down even further and the Fed starts to cut.
How much credit risk should I take here, Emily, or should I just stick with my safe treasuries?
I mean, I know it's boring, Paul. I know it's boring to just love high quality bonds. But when we look at high yields right now, the yields are elevated, of course, but you're not really getting rewarded. I mean, spreads are still sitting at around 300 basis points above treasuries on high yield bonds. That is pretty unusual. We actually did some analysis suggesting that when spreads have been this tight, the forward-looking 12-month returns on high yield bonds are right around 0 to 1% historically, looking over the past 40 years with a range of +10 to -10. So to us, you just don't need to go down the credit spectrum anymore to generate impressive yields in bonds.
Where is the riskiest spot right now?
Yeah, so it's really in lower quality, sort of growth at any price on the equity side. So we talked about the risks in bonds, but on the equity side, seeing small caps rallying today, I'm actually a little bit surprised by that. Because what we saw for most of the last year was that small caps were the biggest participant in the pivot party, right? The idea that the Fed can resume cutting, the cost of capital can come down. That's awesome for companies that have the highest levels of indebtedness, right? But what we started seeing recently over the past month or so is small caps weren't getting as excited about rate cuts as they once had, because again, it means it puts pressure on revenues, it hurts margins, and it hurts the lowest quality players. So we would be taking an opportunity right now to kind of sell out of growth at any price, meme stocks, if you will, riskier small cap equities, and kind of lean into higher quality stocks that have great balance sheets, tons of cash, and a limited need to tap the capital markets in order to grow. We think those still do well in this decelerating growth environment.
All right, we kind of, I think, in earnest, beginning to kick off earnings today, and of course, we'll really do it tomorrow with some of the big banks led by JP Morgan Chase here. What do you need to see? What do you think the market needs to see from this earnings season?
Yeah, I mean, the trickiest part now is that we finally have a high bar again. Not that that's a great thing, but 8.8% earnings growth is what analysts are penciling in for this quarter. It's the first time in a while that we've had an elevated bar. That would be the highest earnings growth since Q1 of 2022. One thing we're looking for, though, is that 8 out of 11 sectors in the S&P 500 are expected to see positive earnings growth this quarter. So if that does come through, that would help broaden market breadth, which I think is really important for markets given the level of concentration we've seen across mega cap tech names. So I think if earnings can deliver, 9% feels a little bit overly optimistic to me, then we can get that market breadth that everybody's looking for.
Mm-hmm. You know who says 12%? Gina Martin Adams of BI. We're going to talk to her next. Because that's even here's a bar, and then we're going to rise above it. Emily, before we let you go, though, your thoughts on AI. Goldman had a really interesting note out that talked about maybe the hyperscalers won't be investing as much as maybe we thought. Does that change? How does that wind up affecting AI trades? What do you think?
Yeah, I think what we're going to be looking